He meets in 2 hours and we will have a decision from them. More than likely, guys, it seems like it's going to be status quo for the 10th consecutive time. A very small outer chance that there potentially could be a change in stance, but I think a rate cut for now is off the table.
I think high inflation, high food inflation is still going to be a worry and top of mind for the governor. And that's not necessarily bad that, India does not have to follow US cues immediately. We're doing our own thing.
Yeah, well, it'll be interesting to see if I'm watching out for the bank Nifty today, because if the MPC in its wisdom decides to do something around liquidity, then that could spur a rally in the banking stocks. So if something like that comes around, that will be really cool to see. So
we did see a hope rally yesterday on Bank Nifty. It was, of course, the weekly expiry.
Bounce back. There's so many shorts out there too.
Who's to tell what happens?
By the way, guys, just an interesting statistic that I saw. From all the rallies that we talk of, all the world markets around the world, the US now, and there's a chart that we have, the US now accounts for 50% of the world market cap. This has not happened before in its history. But the US stock market...
What was it at?
Well, lower. There's a trend line which comes in. At some point of time in the past, it was 45% as well. But now, the US is 50%. The mother market is 50% of all equity markets around the world. It's a telling statistic of the dominance of the US markets, really.
And that dominance not moving anywhere, even though, resurgent China, which is being hoped for, or India booming up there. But it doesn't mean there's no room to grow. Talking about US markets...
I'm also going to put it out there, while we are doing exceptionally well, the fact is it's one of the oldest markets in the world. So for good enough reason, when it says 50%, I mean, there's
but 45% sometime back, and the oldest market has only strengthened its dominance. That's the point.
Well, it's a mother market and mother central bank for good enough reason in that case.
All right. So US markets and how they fared, good day. Good day on the straight. Tech stocks make a comeback, and you see how US markets have been doing. The Nasdaq about 1.5% up, Dow up in the green as well. So was the S&P 500. Dow futures mildly in the red. Nvidia, for example, was up 4%. The focus now shifts to a couple of things, mainly inflation data, which will come out over Thursday and Friday. That's the weekly data. That's standard, but also Friday onwards is earnings season in the US. So that focus shifts in the US markets as well. In terms of bond yields, they've stayed above 4% for the 10-year, so pretty much flat, not too much movement there. I think the interesting bit that I saw was crude coming off. And in part because of a report in the Jerusalem Post saying that Israel could be targeting military and intelligence reserves or military and intelligence sections of Iran, not so much their oil reserves. So that has given some relief to crude. Nothing has happened there yet. The Brent was at $77, so come off quite a bit. Asia has been decent following US cues. Asia markets have been improving. We should pull up what Hang Seng is doing this morning, and some recovery there. Shanghai today taking a tumble, 3.5 points down, but Nikkei is doing okay. India implied open also indicating that we might have a positive start, about 20 points up. So nothing too much to worry about, at least in the first bit of the morning. But look at fund flows. Fund flows continues to be an important story for us to track, because FII selling has been relentless. Foreign investors sold about 5,730 crores yesterday. Domestic investors bought 7,001 crores. And look at the figure for all of October. In October so far, FIIs have sold upwards of 44,000 crores. 44,216, and DIs have bought 46,674 crores. So there's a very clear tussle over there throughout, and I suppose it is domestic money which has come in and saved the day yesterday, because we had a great bounce back after a shaky start in markets, and some of that momentum will possibly continue.
Indeed. Just a quick one. You mentioned crude, and that, of course, is a risk-on trade. But what also has been selling off for the last 5 days has been gold.
Yes.
So you'd imagine the geopolitical uncertainty would have led to higher gold prices. But 5 straight days of losses on gold. Spot gold continues to trade lower this morning. It was off about 1.5% in overnight trade. Along with that, silver has seen a big cut, so it's down about 4%, and platinum has seen a cut of about 1.5%. This number has come in rather unexpected because the general belief is that gold could be headed all the way to levels of $3,200 in the next couple of months. What we are currently seeing could be interim profit taking of some sort on the asset class. But let's move on from there and tell you what trade looked like. It was a very, very interesting day. The markets on Friday, Monday had attempted a recovery but had failed towards closing. Yesterday, for a change, was different. The markets ended at the day's high point, the bulls exhibiting some control and the Nifty closing slightly above the level of 25,000. The gains were led by the broader markets that outperformed the benchmark in many ways, with the small, the mid-cap and the micro-cap index doing much better than the benchmark itself. What's interesting is that the recent selling has been led by the frontline stocks, but what we have seen is the broader markets actually rebounding very sharply in trade yesterday. In the last 6 days of carnage, 27 lakh crores of market cap has been eroded. So most of your mutual fund portfolio NAVs have seen a sharp cut in terms of trade. Well, apart from that, what also stood out yesterday is that the September 11th swing low of 24,750 was respected. So we touched that level, dipped very briefly below 24,700 and managed to rebound beautifully well to close about 25,000. Bank Nifty did well. Like Niraj said, some anticipation commentary on liquidity could potentially have been a hope rally for banking stocks. Also, the fact that it was the weekly option expiry on Bank Nifty could have helped the index close about 500 points higher. Stocks that led the rebound from the Nifty 50 were the ones that led the losses. So you had the HDFC, the Tata Motor and Reliance Industry that managed to eke out sharp gains in trade. What also stood out across a few other markets was the likes of a Varun Beverage that gained significantly, largely ahead of the board meeting today. You had PTM that saw a big surge, finally turned positive for the year, and the volumes are very significant on this one. Metal stocks didn't have it nice. Steel majors like Tata Steel and JSW Steel sold off on back of lack of a stimulus coming in from China. The VIX as well has cooled off quite sharply in trade yesterday. All in all, it was a healthy rebound. It didn't seem like a knee-jerk reaction because for the most part of the day we traded higher and closed at the day's high point. But Niraj, bulls going to extend this rally? What does it look like this morning? It's a flat start on implied Nifty.
Just on the healthy rebound before you come in with the trade setup, I mean, it coincided completely, I don't know if that was the reason, coincided completely with the poll outlook changing.
Entirely.
It was exact, those exact 20 minutes at some point between 9:30 and 10 when you saw the Haryana results changing, and if you put that side by side with the Nifty intraday, that was exactly where the whole table turned, and that was very interesting.
To the T, actually. The only thing is, I mean, call writing still on the Nifty outpaced the put writing ahead of MPC. So that was the interesting piece. I mean, I would have thought that therefore maybe a tempered outlook today as well.
And I think that would be fair because we've done okay yesterday for whatever it's worth. And let's not forget that Friday the markets attempted a recovery. We failed. Monday you had a similar picture. It was only yesterday that it came together.
Yeah, prices are getting sold into. And you know, the other pieces, oil sensitives might see a bit of a gain today because crude has pulled back. But remember, the Israel attack, or at least the chorus around that seems imminent, and therefore I reckon that gains into any of the OMCs might be short-lived as well. I really doubt people will really go out and believe that this is going to be a sustained downtick yet again, because there is a threat of a pullback in crude prices as well. So that's to be watched out for. And I just wanted to mark today, I mean, because it's so difficult to call the markets, but just notable stock movers from yesterday's session, right? Paytm bounced from lows, and now people are talking about multiple reasons, including Motilal Oswal buying nearly 50 lakh shares off late. Watch out for that one. Watch out for Trent, the new business line, and the uptick that we saw in a Nifty name behaving like a mid-cap name yesterday, or the Adani Group stocks, because the fundraising apparently is imminent. Standard disclosures, of course, the Adani Group owns NDTV Profit, but this is the chatter in a bunch of market circles that the fundraising exercise is imminent there. Or Trill, strong results, and for an expensive stock to be locked on an upper circuit after those results, it just shows that the market really went bottom up yesterday. and picked out stocks that it wanted to bet on.
You're talking about
moves there.
Ola recovered,
Ola
Vodafone recovered, everyone who was losing out, all the stocks that were losing out were recovering.
You know, you mentioned how Motilal has picked up some stake on Varun Beverages on Friday.
I meant
on
Paytm.
On Paytm. On Friday, from what I understand, they picked up nearly 1% in Eris Life Science as well. So just to keep things in context, anywhere where there's value and there's a potential for a big growth is what Motilal is going after. Or any significant fund manager would go after in that sense.
Yeah, but the other big story today, of course, is MPC. MPC expected to maintain status quo. Now, the repo rate currently, of course, at 6.5%. But I think this is also going to be interesting, guys, because 3 new external members. So let's wait and see what their stance is. Ram Singh, Shogata Bhattacharya, Nagesh Kumar. Shogata, of course, favorite on business
and
news
he's
channels.
been very vocal that the RBI should be moving with the rate cut.
Father market listed RBI.
You also, just talking about rate cuts, you also the New Zealand Central Bank that's going in with the
Yes,
rate
as excited
cut
as we are about the New Zealand Central Bank, but all focus today on Governor Das. And I think some signs of a slowdown in economic growth are visible. So that becomes important. CPI inflation came in at 3.65% in August versus 3.54% in July. That is going to be a pain point. Inflation is within the central bank's target of 4% because of base effect, but is expected to inch closer to 5% maybe for the month of September. So, the fact that economic growth, and we're seeing that with all the business updates when it comes to your consumption side, is perhaps not exactly what expected in terms of rural recovery, is something that we could wait and see from the MPC.
Should be interesting to watch. But what about stocks, guys?
We have a few. We have quite a few. Our earnings season as well that kicks off. You've got a small company, which is a recent listing that reports today. So Western Carriers and GTPL Hathway, amongst a few other smaller names, will start the earnings season today. Well, in terms of counters to watch, while there are a bunch of provisional business updates that have come in, we'll of course talk about that in more detail with our researchers. But a few that are stocks that you want to track this morning is Welspun Enterprise. The company has received an LOI from BMC for Waterway Tunnel, and it's a pretty significant order from what I understand, at the tune of 1,989 crores. Now, we don't know whether this is a contract for 1 year or is a multiple year contract, but of course, sentimentally, this should be a positive. The stock went home with gains of 3%. Some more gains cannot be ruled out in trade today. Well, apart from that, you have Torrent Power talking about LOCs and, LOIs. This one too has got a letter of award for supply of 2,000 megawatts of storage capacity. The revenue that they're expecting to earn from this project win is about 1,680 crores. So Torrent Power could be one more in focus this morning. Talking about provisional updates, you've had a few numbers that have rolled in. Signature Global, we'll talk to the management on the show, but I'll quickly highlight for you what they've managed to do in this quarter. They've had a pretty significant quarter in terms of reported numbers. YOY, they've seen a growth on pre-sales to the tune of 184%, and they've clocked in that actual number at 2,780 crores. Pre-sales, surprisingly, YOY have jumped so well, but quarter on quarter there's been a decline of nearly 11%. Collections also for this quarter, YOY, are significantly higher by 28%, but Q on Q, there's a decline of 24% on collections. So while on the face of it, that number looks good, it'd be good to understand why they've seen a Q on Q slowdown when the year-on-year number looks rather phenomenal, guys.
Absolutely. Some of the stocks that I'm looking at this morning, first one being Phoenix Mills. The Q2 business updates were pretty decent, actually, and Phoenix Mills is a stock which has really had the rough end of the stick over the last several sessions. In fact, if you pull up the 3-month chart, Phoenix Mills has really had it rough. But their Q2 business updates not half bad. Retailer sales up 25% in the second quarter. And it's up 25% in the first half as well at 6,506 crores. Retailer collections are up 27% in Q2 FY25, and in the first half, retailer collections are up 29%. Average trading occupancy across major malls at 92% is not too bad. Nuvama also is pretty positive on them. They've maintained their buy rating with a target price of 1,857, saying The consumption growth for this quarter, year on year at least, at 25% definitely is on track. Weighted average trading occupancy at 92% is seen as a positive. They continue to maintain a bullish stance on the company. And entry in new cities and operationalization of under construction assets are the next big trigger points for Phoenix. So that's a thumbs up. Senco Gold is the other one. Now, this is one consumption space which doesn't seem to be having too much trouble. Perhaps high gold prices have also helped in their overall numbers looking good. But look at their same store growth, which is improved to 20% in Q2 versus 4% in Q1. So that's a significant jump. Retail growth is up 27% in Q2 and 19% in the first half. That's not bad at all. Their forward outlook is launching 8 showrooms. They have done that in first half versus a guidance of 18 to 20 jewelry showrooms. So that's a bit of a downer. But management expects 18 to 20% year-on-year revenue growth. Overall, because of their SSG figure, Senco could be seen as a positive. RB Infra toll collections are looking decent. They've also given business updates. Focus now on business updates before we come into results season full-fledged. Up 19% in September. Management remains optimistic about sustaining growth levels as well. So last few months have seen a decent increase. So relatively 19% would be, lowered down because you have seen in July a 37% increase, in August a 20% increase, and 24.9% in June, and then 19% up in September. But IRB Infra would be another good set of business updates, at least for now.
Torrent Power seemed interesting as well. 2 LOAs. The one came in earlier. I think you spoke about it. Did you speak about it?
The 1,680 crore.
But it's interesting that it includes 1.5 gigs of the previous order as well. So therefore, the 2 gigs one is interesting. And then some brokerage notes were very interesting to my mind. So yesterday and day before, we saw some upgrades on Mahindra and Mahindra, citing that the tractor cycle might be an upcycle might be underway in FY26. Now today, MK has a note on Escorts. They've upgraded the stock to a buy with a target price of 4,700. They are saying they value the company at 30 times September 26 PE plus 320 rupees cash per share. But the rationale, and it holds true for M&M as well, obviously, that the recently concluded monsoons lifts the outlook for upcoming crop cycles. They say that this is a very important line. They say that the industry base is turning favorable because the industry degrew 13% in H2 and is flattish in FY25 year to date. So therefore, the second quarter might have a favorable base of the last year. And then, of course, since FY25 is flattish thus far, the next 2 quarters after that. So effectively, the next 4 quarters have a very favorable base effect as well coming into play. So watch out for Escorts in the session today. M&M already has had 2 good days. Let's see if Escorts kinds of picks up the mantle. So that was the first one. Then Citi has a note on divvies, which is also very interesting because amongst other things, they've of course initiated coverage with a buy rating and a target price of 6,400. They are saying that a company securing its place in GLP-1 APIs can be an $800 million revenue potential for the company by calendar year 30. They are also saying that divvies is a key beneficiary of the supply chain diversification trend. By the way, viewers, in this note, they're laying it out that divvies has gotten new names, ribociclib, as well as some other drug and clients that they have already added, and therefore there is potential not just in the future, but something that divvies has already done, and therefore they are constructive on divvies. So it's one more name that I would certainly watch out for in the session today. And as I mentioned, Paytm was a big one yesterday. It was the biggest performer on the BSE 500 or the NSE 500 as the case may be. Fund buying has happened of late. They've met some marquee names. There are a lot of rumors doing the rounds about maybe some clearances coming in for some of the businesses that haven't worked for Paytm in the recent past because there was a pause. If all of that works out to be true, it could be an interesting name. So just from a trade perspective, keep an eye out on Paytm in the session today as well.
And it was above average volumes as well. So it was a good gain. The stock is now finally up year to date. Just a mention, I don't know how significant this could be in terms of stock movement, but SEBI has issued an administrative warning to Nuvama Wealth Management after inspecting the company's merchant banking activities. Nuvama has stated there's no material impact of this on its financials, operations or other activities, but sentimentally there potentially could be an impact on the stock. So you keep an eye out on that. Along with that, there's also Dr. Reddy's, a rather complicated product launch for them, but there's been some approval on a significant product that they've been working on, which is for myeloma patients. So we will, of course, get more details on this, and Varsha joins us with more on that. But it's all about IPOs and it's all about Hyundai. You want to come in?
Yeah, just before we get to that, just one macro piece that I wanted to highlight, that FTSE Russell's benchmark bond index has added India, right,
yes,
along with South Korea to its gauge of the emerging market debt. And interestingly, that story that came out mentioned that while South Korea made a big push for getting included this, New Delhi was completely sanguine about this, that if it happens, it's great. If it doesn't happen, no problem. They did not made too many overtures as well. So it's significant that India is now getting included, because for the longest time, right, I mean, it was this conversation around the JP Morgan Emerging Market Bond Index and what does India need to do, etc. I don't think we did too much even then, but it just happened because a lot of global managers were asking for it. Now this has also happened without New Delhi making any pushes for it. It's a big, significant development, guys. I mean, it may not be as big as the JP Morgan Emerging Market Index,
right,
but coming on the heels of that inclusion, this is really good for the Indian bond market depth.
And for the way India is viewed as an economy as well,
Exactly.
because with such inclusions comes greater answerability. And yeah, I get your point that we played it cool and we made it in.
But so you also, this of course happens in September 2025. Before that, you also have inclusion on the Bloomberg index, which will happen much before that, which is in Jan 2025. So you may not see an impact on flows into bond markets just yet, but sentimentally, like both of you said, it's a great positive. But I think it's all eyes on international players listing in our country.
Yeah, I mean, Korean players listing in our country, and Hyundai is the big one. So some details out. Puneet, take us through that, of course, and more importantly, the comparison. After the numbers are out, how is Hyundai stacking up against peers?
Well, definitely, India's biggest IPO in terms of the money raised, roughly about 27,870 odd crores. The last one was LIC at around 21,000 crores back in May of 2022. So definitely a big IPO coming in. Now the price band is set to be around 1,865 to around 1,900 rupees, 1,960 odd rupees at the upper price band. And it's expected to open between 15th and 17th of October. Now the bids can be made in a minimum of 7 equity shares and multiples of thereafter, offering roughly 14.2 crore shares via an OFS or offer for sale, and there is a no fresh issue component in this particular IPO. When you look at, the key other details, that the indicative market cap of the company is going to be around 1.58 lakh crores based on the upper price band of 1,960 rupees per share. And, the anchor portion currently as per the RHP is roughly 4.2 crore shares. They roughly translate to 8,300 odd crores. It's a big participation needed from mutual funds as well as other HNI investors to make this IPO a key success. Now, when you look at the split between retail as well as QIB around 15%, retail has been around at 35% in this particular IPO, so it will look at participation. Let's just look at some key numbers. The sales growth has been really strong for Hyundai, around 7.7 lakhs in FY24 specifically. It's a big growth of about 8% from the previous year, while for Q1 as well, it's been a 5 to 6% growth. It's really strong compared to 1.2 lakhs. I also want to take a look at the export numbers. Roughly 24% of what they make in India is exported to Southeast as well as Southeast Asian markets, and that's one of the key things that aids margins as well. And when we look at the next graph, we'll be able to see the financial impact of that as well. So for FY23 and 24, the growth we can see roughly 69,000 crores of revenue in FY24. When you look at the margins, also really strong at 13.1%, and that's higher than what Maruti did for FY24, roughly about 11.6% is what they reported. For Q1 also, we have the numbers. Again, really strong margin profile at 13.5%, and that's reflected in the strong numbers as well. When you look at, the next, and we want to make a comparison between that and Maruti, as you rightly said. Now for sales, the volumes, it does roughly 1/3 of volumes of what Maruti does at around 7.7 lakh units, while on revenue it's half of Maruti. Look at the margin profile though, higher than Maruti, or what, as we mentioned, by roughly about 150 basis points. So a big jump there. Profitability as well. Of course, Maruti is higher, and I want to just take that point. Why is it higher for Maruti like that? On a gross fixed basis, now we've taken this particular metric is on depreciation on the gross fixed assets. So Hyundai depreciates higher compared to Maruti, and that lowers the profits as well. For other income component also, Maruti is very high cash generating, while the tax is also lower for someone like a Maruti. So that's where we see the divergence in profitability, but EBITDA profile of Hyundai is really strong. Finally, when you look at the value, the key valuation picture here is dependent on three things. One is the net worth of the company. Now we saw a very big drop in net worth from FY23 levels. So from 20,000 crore of net worth, it's roughly half to 10,000 crores, and that's because they had a very big dividend component in this particular time frame as well. So if you see the dividend component in Q1 was specifically very large, and that's one of the key things. So 15,000 crores of dividend in FY24 versus just 1,400 crores last year, and that's reduced the net worth for the company as well. Finally, on price to equity basis, it was expected to be around or even a premium at some point of time to Maruti. That's not the case now. When you look at the net worth, we didn't mention it, but ROE has dropped because of the high dividend payout. Look at the market cap to PAT though. It's coming at 1.58 lakh as we mentioned, so it's lower than that of Maruti. On EV EBITDA basis also, it's much cheaper. Price to earnings is something because, a lower PAT for Hyundai. So that means the price to earnings is similar at 26 times. But overall, a very big thumbs up on the issue basis on the, the high export sales, higher margins compared to, someone like Maruti Suzuki. But it's going to be key to see if this issue gets lapped up as, one of the biggest issues as we spoke about. Back to you.
It's a very big one that the street is watching out for. What will be interesting to see is if this squeezes out some liquidity from the secondary markets from domestic investors. This is an opportunity that the street is closely watching out for, and we've seen smaller issues that have hit the street over the last couple of months have been oversubscribed in a very big way. But it's all eyes on the Reserve Bank of India as they will give us the economic decision on rate cuts, inflation growth and more. Pallavi is standing by with more on this. Pallavi, this is a very significant meeting in more ways than one. Firstly, of course, it comes in on the heels of the Fed cutting its rate. Secondly, there's so much of uncertainty globally. You've got geopolitical stress, which is impacting the way crude prices have been moving. More importantly, locally, you also have new MPC members. There's so much going on, but it seems like the consensus is status quo. Would you agree? What is the sense you're getting?
Right. Hi, Samina. Good morning. It's beautiful weather here outside the RBI. There's, in fact, a little bit of a drizzle going on here as well. And there is a chance that that might actually be the most dramatic part of this entire meet. That's because, like you said, the consensus on the street is that of a status quo, with, in fact, just 3 of the 43 economists polled by Bloomberg actually expecting a change in the benchmark lending rate. All of the others expect the RBI MPC to continue to maintain a status quo with the lending rate at 6.5%. Now, like you said, there's still a lot that we're going to be watching out for, despite the fact that there are fewer chances of a rate cut. The fact that the 3 new external members that have been appointed, it's their very first MPC. We're going to be watching out for which way they sort of tilt towards. We're also going to be watching out for any impact of the global geopolitical developments, the Fed rate cut, the weakening that we have seen in several high-frequency indicators in recent weeks. Whether any of that sort of seeps into the RBI's communication and how it decides to word itself this time around. What else has changed since the last policy? Well, let's talk about inflation. First up, retail inflation was at 3.65%. That was for the month of August, and that was compared to 3.54% that we had seen the previous month in July, when inflation actually fell to the lowest in almost 5 years. In September, we are expecting a little bit of an uptick back as the base effect normalizes. We expect inflation to print closer to about 5% in September. And food inflation also continues to remain elevated so far. So that's something the RBI is likely to continue to remain cautious about. Like you said, what else we're going to be watching out for is, of course, the impact of the Fed rate cut, the latest geopolitical developments, escalation in terms of the geopolitical conflicts, also the impact that's had on crude oil prices. Going forward, of course, we're watching out for the US elections, how that might impact China and in turn India's currency. We're already seeing some hit of global slowdown on the exports front as well. That said, despite the fact that it is expected to be a status quo, some economists do expect a change in stance. But let's remember, we have seen the RBI actually change the lending rate without changing the stance earlier as well. So that's something we're going to be watching out for.
Yes, Pallavi, we've got lots to watch out for, and you're right, the weather is rather pleasant this morning in Mumbai. Well, we have with us Lakshmi Iyer now, CEO of Investments and Strategy at Kotak Alternatives, and Tanvi Gupta of UBS, joining in with their expectations. Lakshmi, I'll start with you first. The backdrop of this policy meeting is different. The Fed has finally moved towards a rate cut, but there are also rising concerns around the geopolitical setup. What are your expectations from the RBI? Will it be status quo, or do you anticipate an actual rate cut or even a policy change in stance?
No, I think you elaborated it so well. There are multiple confluence of factors. Definitely geopolitical tops the list as we speak, which has obviously led to, rocketing of oil prices, though it's well below the RBI's anticipated threshold. Added to that, also we need to keep into consideration that China's stimulus could have its positive impact on commodity prices. And of course, these are the two banes, if I were to say, and the boon definitely is the supersized rate cut that we saw in the US with an expectation of more to follow. So if you blend all this together into one jar, it does not, still give you the recipe of a rate cut in this policy, looks like for now. However, could there be, given that even domestically we are seeing a mellowing down of the economy, could that probably lead to a change in stance? So at the current juncture, I think I would probably lay a bet more on that rather than a rate cut in the policy.
Lakshmi, but historically, we've all seen that once the Fed starts moving on rates, the RBI does follow. And that's largely to keep the rate differential in check. Do you think this will weigh on the Governor Das's decision, or do you feel like we've come a long way from that and we could maybe wait it out a few months before we actually start worrying about the impact on rate differential?
No, it could be. I'm not ruling that out, but at least, as I said, that would not be our base case assumption. Could this be a probable pivot towards that, rate action probably in December or more realistically in Feb? I think because, you would have then the US elections out of the way, you could have some more impact or, expectations of what more could China do to create stimulus, because our view is China is still not done with respect to stimulus. They need to do more to pump prime their sagging or ailing economy. So I think, not doing a rate action right now versus pushing it to a December or Feb would not materially distort the apple cart for India, but still they would have some more data points to reckon with. So I think a change of stance could, as I said, could be a more joining the bridge and connecting you to the rate action eventually. And of course, let's not forget, I know it's more for base effect, even September inflation, the headline is likely to be at least 100 to 150 basis points higher than what the August reading was. So I think some of these could play on the MPC's mind. And of course, we have, a bunch of new MPC members as well. They also need to take stock of some more data points. So I think that's where we are, veering towards.
Well, Lakshmi, hang in. We also have Tanvi joining us to talk to us about what her expectations is from this policy. Tanvi, good morning. Thanks for joining in. Tanvi, what are you expecting? Do you expect this to be another policy meet or rather the 10th consecutive meeting without a change in stance or rates? This one, of course, we ask because there are a bunch of new external members who've joined the team, and the likes of Sogato Bhattacharya have been very vocal about a rate cut that is required or is the need of the hour.
Absolutely. So I think this policy, even if I look at what is happening on the macro front, we are seeing signs of softening. We have already seen leverage-led growth is also kind of fading down. Inflation, at least for the month of September, and the data which you will get on, next week post the monetary policy will show an uptick. So largely, if I look at rates as well as on the stance, we are expecting status quo. We are not expecting RBI at this point to change the policy stance, which is right now withdrawal of accommodation. This policy will be a very interesting one. As you rightly mentioned, there are 3 new external MPC members joining. If you remember, in the last 3 external MPC members, 2 were quite dovish and were voting for a rate cut. So it is very interesting to see how the new external MPC members, because the starting slate is going to be more towards neutral, is definitely going to set the space on how the monetary policy forward is going to shape up. The second interesting thing is if you look at RBI's growth forecast, they're at 7.2%. For FY25, we are at 6.8%. Even in the economic survey, we have seen that the government was even mentioning that the growth could be closer to 6.5–7%. So clearly, RBI is slightly optimistic on the growth front. And when I track UBS India Composite Economic Indicator, which is a compilation of 15 high-frequency data for India, it is clearly showing me that the momentum has started to soften, specifically from August onwards. So, for example, June quarter, we were all expecting that the growth would have slowed because parliamentary elections happened. Plus, there were heat wave conditions in April, May, and the growth would begin to normalize from September. But at least whatever leading indicators that we are tracking is not really showing any big uptick in the growth momentum, even in the September quarter till date.
Right. Thanks, Tanvi. Thanks, Lakshmi. It seems like it's going to be a status quo for the 10th consecutive time, not just on rates, but also on the stance. Very small audience believes that there could be change of stance to neutral. Implied Nifty is indicating to a very flat start, but this comes in on the heels of a pretty sharp rebound, or rather healthy rebound that the street witnessed in trade yesterday after the 6-day carnage that we've seen. We'll take a break. We'll come back. We'll put the spotlight on the F&O space, so stay with us.
Hello and welcome. This is India Market Open, an exciting day. One of the last few weekly options expiries for the Bank Nifty, and on a day when we have the MPC. Well, it's going to be yet another interesting one to keep an eye on. But let's see how markets have fared yesterday. It was a day of recovery. There was no doubt about that. We did see, in fact, about a short covering in a handful of these indices. That when it comes to the Nifty specifically, an up move around nearly 1%. We reclaimed 25,000. And for the Bank Nifty, the short covering was very, very evident in the kind of decline that we saw. 3% decline in open interest, even as the index moves by about 1% and reclaiming 51,000. Today is also where we were keeping an eye on the Nifty options. Of course, we're going to see 25,000 behave as a little bit of a fulcrum, a pivot of sorts for now. And of course, on the higher end, we continue to see a lot more traction and a lot more writing in terms of the 25,500 call. The Bank Nifty, on the other hand, is where we're starting to see 51,000 as a little bit of a mainstay as well. Now, it's a wait and watch whether or not we can, in fact, sustain about that level. The first hour trade will determine that. But it was a good day of trade, no doubt, when it comes to individual stocks. A lot of longs in Max Financial, Ipca Laboratories, MCX and Coromandel International. Even in terms of stocks which saw unwinding. Well, a lot of short covering for names like Trent, REC, M&M, as well as Adani Ports. Trent specifically stands out because it made a new life high yesterday, even as we saw a sharp up move around 8% and a decline of 6.5% in open interest, while wiping out all the losses that we saw in Trent over the past 3 to 4 sessions. But with that, let's take a look at what we can potentially do with markets as they stand right now. We have Avni Bhatt of GM Financial who's joining us on the show right now. Avni, good morning. Thanks so much for joining in. Avni, I believe you do have, two stocks on your radar, and the first one is Alkem Labs. Let's start with that one. What is your assessment on Alkem Labs, and how are you playing derivatives here?
Good morning, Agam, and a very good morning to all the viewers as well. So yes, in the recent mayhem in the market, the price action in Alkem has been robust with no major sell-offs. Now, after nearly 2 weeks of consolidation, the stock has formed a bullish engulfing pattern on the daily charts. Along with a long addition, open interest addition in futures, in October futures, and unwinding is seen in 6,300 calls. So there's a positive RSI crossover with volumes higher on green days, while whenever there was a minor profit booking session, the volumes have been pretty low. This indicates that the strong hands are holding on to the longs. And the setup looks positive for a up move up to around 6,500 in the October series. So we go for a covered call strategy in this particular stock with buying of October futures at 6,300 and selling of 6,400 call, which closed at around 125 yesterday. The target on this strategy, if at all our target of 6,500 is reached, we'll be making a profit of around 22,000. And stop loss can be kept at 8,000 rupees on the entire strategy.
So that's the view on Alkem Laboratories. But going ahead, you also have yet another stock which is on your radar. Which one is it? I believe you are looking to buy a call there.
Yes, so that's from the IT pack. We saw some sell-off in the IT sector yesterday in the first half of the day, but the recovery was pretty good. And in past 6 weeks, and the stock that I'm talking about is HCL Tech. So in this past 6 weeks, on every correction, the stock has made a low in the region of 1725 to 1730 and reversed from that level. Now, yesterday when the IT pack faced some selling pressure in the first half of the day, HCL Tech made a low of 1743 and reversed sharply during the day on good volumes and a single day long open interest addition of 4% in futures. It closed above the 20-day exponential moving average and is expected to continue the positive momentum up to 1870 in a very, very quick move. So ideally, a higher low has been formed. Higher high should be formed in this particular week. So weekly closing should be on the higher side. And that's why we are expecting a very quick momentum. So we go for a vanilla call option of 1800. Which closed at around in the range of 40 to 42 yesterday. Target would be around 72 and 80. And the stop loss can be kept at 24.
Quite close to 1800 at the moment, so nearly at the money, this specific call. And of course, for many reasons where we can potentially expect a sharp up move in HCL Technologies is the reason why Avni is recommending buying a call option here. But Avni, on that note, thanking you for joining us and taking us through your two ideas and how we can use options in those specific areas. But with that, it's back to you all.
Thank you for that, Agam. And, I think two sets of stocks which will be in focus today. IT, after the drubbing yesterday, might see some of a bounce back, a bit of a bounce back because of what we've seen in the US markets. But the other one is definitely metals. Now, metals have been in focus thanks to China. A lot of updates coming in from China, and yesterday those updates were negative. China's plans for revival were not something that global markets were looking at too positively, and metal stocks, as a result, lost luster yesterday in trade. But interesting note with Citi, which seems quite optimistic on the outlook for metals, isn't it, Mihika?
Yeah, they are most positive on the prices in the 0 to 3 month period, and they've raised the near-term prices for this period itself, and they expect this on the back of their expectations for China to see further policy easing, with most of them coming and being announced in the end by October end. Now, the Q4 2024 average prices for metals are broadly in line with the current spot prices, which kind of reflects their near-term bullish views. And when you talk about the revised price estimates, now these are all values in dollar per ton. The iron ore price forecast is raised from 85 to 120, copper from 9,500 to 10,500, zinc from 2,800 to 3,300, aluminium from 2,500 to 2,750 rupees, and this is for the 0 to 3 month period. Now, yes, the National Development and Reform Commission conference was taken negatively by the markets. China markets were also in pressure at the start of day today, with the pullback in iron ore and base metal prices also seen. But when you talk about how you can place your bets, well, Citi expects the fiscal easing to provide investors with a tactical buying opportunity, especially in iron ore and copper. But the overall view on base metals, which includes your aluminium, copper, zinc, lead, the conviction remains low, and their bearish view is mainly due to three reasons. One is the potential major escalation in the Middle East tensions that we're seeing right now. The negative aspect of the tariffs if Trump does win the November US elections, and the deteriorating US labor and economic data if it is to continue.
Okay, so metals definitely in focus. Well, let's tell you what else is on NDTV Profits watch list. Thank you so much for that, Mihika. The stocks we're tracking this morning, SKF India. The demerger of the industrial business will be seen as a positive. Tata Tech, though the joint venture with BMW was announced some time ago, we now have more details on it. In fact, you will hear from Warren Harrison just a bit from now. Signature Global has come up with its updates for the second quarter, and pre-sales up 184%. We're going to be speaking with the company as well. Phoenix Mills has seen retailer sales up 25% year on year. That's on track. Wellspun Enterprises is the other one that we're tracking, isn't it, Niraj?
Yep, received the LOA from BMC for the waterway tunnel worth 1989 crores. This was formally announced 2 weeks back, but now the LOA is there too, so maybe the stock reacts. Torrent Power has received letters of award from MSEDCL for up to 2,000 megawatts of supply, including 1,500 megawatts of an earlier order. IRB Infra is the other one, wherein the September toll collection is up 19% YOY. TRIL, the numbers beat estimates as per Nuama. Their target price is 41% higher. And GMR Airports, concession agreement for operating the Nagpur airport formally received, and maybe that stock too sees a bit of a reaction. Well, just the number of stocks on the positive list today show you that the day looks like it might probably be in the green, because the news flow as well on specific stocks is very, very constructive. Let's test that with our two experts, Kush Bora, founder of kushbora.com, on the technicals, on the fundamentals, Mayuresh Joshi, head of research at Market Smith India. Gentlemen, both of you, thanks so much for joining in. Kush, good having you in the studios. What is the, good morning, and what's the index strategy for today? Should one go out and trade the Nifty on the upside once it opens?
Sure. First of all, very good morning, Niraj. Two camps and two views. One is that this was the first day of recovery that we saw yesterday, so you might want to wait for, let's say, critical level like 25,200 to be taken out, and then perhaps go out and create, a long position, just to be sure that yes, the near-term bottom is in place. The other view is that the corrections that we've seen in the recent past have been shallow and short-lived, and the recoveries also have been swift. So you wouldn't really get a chance to buy the dip if you aren't really the fastest finger first. So depends on the camp that you're sitting in. However, what this does is that it does two things. One, that the risk-reward ratio is extremely favorable if you want to go long, because both the Nifty and the Bank Nifty have supported, taken support at the key levels. And what is happening, this is setting a stage for a nice Diwali rally. Either way, a long trade is warranted on the Nifty and the Bank Nifty both. But as I said, if you're a more cautious trader, you might want to wait for 25,200 to be taken out, or if you want to take multiple positions, you might want to take some now and then perhaps pile on once 25,200 is taken out. Positional stop loss comes in at 24,700, which is close to the recent lows that we've made.
So are you... Sorry, are
I
you...
want to quickly ask Kush on this. Because a couple of days ago, and I'm just playing devil's advocate here, on Friday you were very negative on the index. I know that yesterday there was a decent, healthy pullback, and you've said we should go long on the Nifty. My only point is things are changing so very swiftly. Do you feel like running these positions overnight is advisable? Because the fact still remains every sell is being used as an exit by long traders or traders who've been stuck.
So I'll tell you what, even Friday, in fact, even on Monday, the view was that the markets have fallen with some ferocity, but we were seeing positive divergences on the hourly setup, which was suggesting that the downturn or the selling was perhaps exhausting or was coming to a close. So even if you did have short positions, it was a good idea to cover back then. Now, you're right that the recent move suggests that the highs are being taken as an opportunity to exit. But if you look at it from a positional standpoint, I think what's happened is that you won't really get a chance to enter, and you might see Nifty at 25,500, 25,700, let's say 2 weeks from now, and this might seem like a missed opportunity. So that's why, even with a cautious view, and hence I'm presenting both the views, depending on the camp that you're in, but depending on which camp you sit in, there is definitely a case to go long and at these positions, at these levels. Just that you might want to have a smaller position if you want to consider this rally as a sell on rise.
Okay, Kush, the Bank Nifty particularly though.
Yeah.
Because if the policy has some liquidity measures, even if it doesn't have a cut, it could spur. So are the Bank Nifty charts? So let's ignore which camp a person is in. Sure. Let's assume the person is neutral. And the person wants to know from Kush Bora.
I think everyone's in the money-making camp.
Yeah, exactly.
Let's make money today.
Yeah, don't hedge yourself, Kush.
So she's watching you right now and wants to know whether she should buy the Bank Nifty today on open. What would you do?
So just to go back to my previous conversation, in both situations I've suggested a long. It's just the magnitude of, at which you want to consider. Fine. So that's the first thing on Nifty. I'm a little more constructive on the Bank Nifty. The reason being that, this went into oversold territories much before the Nifty did. It's respected that, 50,000, 50,250 kind of support zones. That was the medium-term support. So Bank Nifty has a lot of room for, upside from here on. Also, something that we've been discussing for the last 2 days is that most of the private banking names which actually led the rally have actually come back to the same levels from where the rally started. Now, take a case for, let's say, an HDFC Bank. Not something that I thought I would say in my lifetime, but if you want to trade, you might want to consider HDFC Bank, and I'll tell you why. 1600 to about 1750 is the broad range, at least for the last 2-3 months, right? And now we're closer to the lower end of the range. So if you do believe that that range is going to be respected, you might want to buy HDFC Bank. And if HDFC Bank moves up, of course, Bank Nifty also moves up. Hence, my view is a little more constructive on the Bank Nifty as compared to Nifty. And if you want to play stock-wise, then HDFC Bank and ICICI Bank are the two stocks that you might want to put on your radar.
Okay, so HDFC, ICICI, are those also your top picks of the day, or do you have trading picks, technical picks for today?
Oh no, incidentally, my picks are far away from the BFSI space, right? Healthcare, pharma, these names continue to impress, and every time we scout for stocks, one of these names pops up. So this time, we've got Ajanta Pharma. Now, if you see the setup, the stock has actually not seen any kind of volatility with the kind of move that markets have seen. It's respected its key averages, gone up on the back of good volume. So Ajanta Pharma is something that you want to consider from a near-term perspective. Targets being 3,500, 3,600, and 3,300 is where you place your stop loss. One company which I think the management was on the show had a very positive view and positive commentary was Tega Industries. This stock too had a fair degree of volatility, but again respected the key support zones. Yesterday, the volumes were very high comparatively on the way up. So this is also suggesting a near-term upside, and the targets here are 2020 and 2080. The stop loss on this one is at 1900.
Indeed, Tega has. In fact, Niraj and me did talk to them a few weeks ago. The only problem on this one, I think, Kush, is that the float is very low. So that, of course, may make the movement and the availability of stock limited, but it's a story in itself. The stock was up 3.5%, like Kush pointed out. Another one that's on the radar, and we will get a view from Mayuresh and Kush both on this one, is Tata Tech. The company has formed a 50-50 JV with BMW, adding to the list of the Boeings to provide auto software solutions. My colleague Tushar had an exclusive conversation with the CEO of Tata Tech and asked him about his expectations from this joint venture. Here's what he had to say. Listen in.
At 18.2% today. We've expanded from 16% over the last 4 to 5 years. Our North Star is about 21%, as you correctly positioned. And certainly we expect the business with BMW to contribute towards the growth of the company and by association to our expectations of margin improvement and profitability. But we've not quantified that as yet, and so our aspirations for this year are essentially devoid of any real or material contribution that we expect from BMW. And I think right now we're just looking at this joint venture strategically. How can it help us develop as a company? How can we contribute to it? And so we can enhance the partnership with BMW and not just look at delivering value through the JV, but increasingly deliver value directly to BMW from Tata Technologies.
You're delivering value. I'm sure you want to also create value for yourself. So when do you think, it's the early days, I agree, but you would want this JV to pay off in material gains in the future. So do you think in next 2 or 3 years it starts paying off? All the effort that you put in the last 18 months and the coming 18 months?
Well, we've demonstrated, I think, that we've run our company in a way that's generated value and wealth for the company and for our shareholders. And when we make decisions, we always keep a laser-sharp focus upon our responsibilities in that area. So, when we make decisions about BMW or any customer, we'll always be looking at it in terms of what we can do for them, but just as importantly, what this means to us.
Back with India Market Open right here on NDTV Profit in conversation with Kush Bora and Mayuresh Joshi. Let's get in Mayuresh's first comments. Mayuresh, thanks so much for joining in. Great having you today on a day after the markets have staged such a good move. I want to talk to you, Mayuresh, about some of the high flyers, right? And trying to understand what's happening with some of the stocks in which the movement was very exaggerated yesterday. Let's start off with Paytm, for example, Mayuresh. I mean, there are some fund buying that has happened. They are getting part clearances from regulators for some of their businesses. The stock has more than doubled in the last 6 months, right? What does somebody who's looking at this now do with a Paytm stock?
Morning, Niraj. I think some sections of the market are extremely optimistic, even after the moves that we've seen in Paytm. And therefore, the hope and the optimism lies on the fact that a lot of the regulatory monetary or financial issues are largely behind them. And therefore, the recovery process is very much on track. And they should be able to post a reasonable amount of numbers in every ensuing quarter that probably comes through. But this is, again, Niraj, a probability and guesstimates that a lot of analysts are probably pegging in. Unless we see hard numbers come through, the kind of move that Paytm already has probably justifies the optimism that is exhibited. So I think there might be better stocks in the broader market, at least at this juncture.
Mayuresh, hi, good morning. Tamanna here. We started by talking about Paytm. Let's talk about some, I call them troubled children sometimes, with a lot of news flow, which is sometimes negative. Let's talk about Vodafone. Let's talk about Ola Electric. Let's talk about SpiceJet. All of them rebounding quite aggressively in yesterday's trade as well. All of them, have had their fair share of negative news flow. Do you see that momentum continuing for any of these?
Morning, Tamanna. I think the questions that are coming today morning are a little bit on the other side of the table. But yes, I think all the stocks that you're probably discussing at this juncture have their fair bit of issues. For Vodafone Idea, I think the kind of regulatory issues that are still cropping up will create stress on their balance sheet. And obviously, you will see some element of a technical bounce back at some point in time. But I think the balance sheet strength to repair is going to take a decent amount of time and several quarters and years, looking at the spectrum payments, debt repayments, the capex that they probably have to do to get out of the legacy 2G network to the 4G part as well. Ola, again, fair bit of controversy that the promoter has probably got into. But the kind of feedback, that we are getting in from social media, the kind of feedback that we have been speaking to a few dealers, there seem to be issues as far as their bikes are concerned. And therefore, I think getting in newer products when your existing products are probably facing a lot of customer service issues might also create a large amount of backlog as far as inventory levels are concerned. And therefore, I think we'll be a little bit watchful on these ones as well. So I think, again, technical bounce back is not ruled out on these troubled children stocks, as you say, Tamanna. But again, better stocks where earnings and price stability probably is there in the market.
Mayuresh, what are you doing with metals? There was a little bit of a hope rally in the last 1 month on these metal stocks on anticipation of that big push coming in from China. And indeed, we did get a push from China last week. Yesterday, after a little bit of a disappointment in terms of additional stimulus, some of these steel stocks have sold off sharply. How do you play the metal pack? Do you use the current weakness as a buying opportunity for a Tata Steel, a JSW Steel from the frontline names?
Morning, Samina. So again, I think the China stimulus has created a huge spurt in or a rally in metal stocks as we see. But again, I think structurally, is there a genuine recovery that you're going to see on the ground over the next 2 quarters? We were speaking, as I said last week, to our team in China as well. And their belief is that it is going to take time. So I think the stimulus measure is a good move on part of the Chinese government. But on ground, I think things are not moving as the markets probably expect. Therefore, I think the only 2 factors that might work in favor is Chinese data points and the economy probably starts recovering. You will see significant amount of restocking that takes place. Inventory levels across metals, whether it's steel, zinc, lead, copper, are at abysmally low levels. And therefore, as restocking takes place, LME prices will start moving higher. This will also correspond along with the Chinese demand of global demand steadily coming back. The Indian demand in the local context has already remained strong, and therefore the operating leverage benefits start moving in. So I think it's all depending on how China data points move in. Aluminium stocks, Samina, Nalco, to a certain extent, where they have their backward integration as far as aluminium and bauxite are concerned, probably might do a tad bit better. One stock outside this universe might also be Indian Metal and Ferrous Alloys, IMFA. Was going through their earnings transcript a few days back. The management sounds very, very confident in terms of better output in the second quarter. Realizations have been very, very steady. Input costs have probably moved lower. Their South African operations seem to come back on track. And therefore, ferrochrome prices are expected to remain stable with the global stainless steel industry expected to grow at a decent pace, even in these times of uncertainty. So I think this is one stock in part that one can answer.
Thanks, Mayuresh. That was such a detailed explanation for what is happening in this space, because a lot of us usually confuse, and also the fact that LME inventory is at a record low is still something to talk about and think about. We also have with us Chandan Taparia joining in. Chandan, hi, it's Samina joining in. A quick mention before we talk about your index call. I was talking to Mayuresh about what one should do with metals. Do you have a trading strategy on JSW Steel, Tata Steel, Nalco, SAIL, anything that looks like a good stock to buy to play a rebound?
Good morning, Samina, Mayuresh, Kus, and all the panelists and the viewers. Thanks for having me. So talking about metal, we witnessed decent recovery at the beginning of the last month, led by recovery in the global market. But some profit booking was seen in last 3-4 trading session. But major trend of this sector is positive. Even on the last trading session, it tested 50-day on the daily chart and turned higher. And talking about the selective name like JSW Steel or Jindal Steel, some profit booking was seen, but I believe buy on decline stance could continue. But one need to keep in mind that metal sector is likely to be slightly volatile because of the global conditions and the global volatility. But overall, the positive stance on mainly the buy on decline could be there. I think you also mentioned about the counter like Hindustan Zinc, but there we need to see some consolidative move. If Hindustan Zinc manages to move above 530, then only the fresh leg of rally. But in JSW Steel, one can go with buy on decline stance with support of 975, and the stock can again head towards 1040 to 1050 kind of levels.
Chandan, very quickly, before we go into stocks and brokerage calls, what is the view on the index? What are you expecting on the Nifty? The bounce from yesterday could continue into today, and any long trade on Bank Nifty as well?
Samina, index remained highly volatile in last 2 weeks. Earlier at the beginning of September or in the second week of September, index rallied for 24,753 to 26,277. That was the rally of 1,500 points. But in last 7 days, index has corrected more than 1,600 points. But now somehow it is holding well with support of 24,750. Index is still making lower highs. However, for last trading session, it formed an inside bar. But it needs to negate the formation of lower highs, then some recovery could be there. So, however, the weakness hangover may not remove immediately, but some recovery or smart bounce can be there in the market. So I believe with support of 24,750, at least we can witness a bounce towards 25,250. And if market manages to move about 25,250, then short-term bottom will be placed for an upside target towards 25,550 zone. So I'll totally look at 24,750 and 25,250 for a bounce back play in the Nifty index as of now.
25,250 on the upper side. All right, time for the big brokerage call of the morning. Harsh is joining us with more. Harsh, you've picked what Nomura is saying about Indian AMCs.
Well, yes, very constructive. 21% upside on HDFC AMC, 24% upside on Nippon AMC. And what they're suggesting is this entire theme of financialization of savings likely to benefit AMCs better over the longer period of time. And I'll elaborate a little bit on that. They're expecting 18% in terms of flows to come in terms of AUM compounding to happen all the way to FY30. And they believe that AMCs are the better play rather than distributors. They believe distributors over the short to medium term may benefit, may be better off. But as consolidation kicks in, as well as more, there's a larger shift towards direct or for customers opting for direct mutual funds, likely AMCs are the better play. That's their thesis. With regard to AMCs itself, they believe core profitability will continue to remain quite robust and is robust. They believe that there's more stability to the business as well. They are expecting growth to be driven more by retail flows. Institutional, they believe, will come more into ETFs as well as index funds, and retail will focus more on the higher revenue share in terms of outside of index funds and ETFs. So the better margin kind of products is where retail will come in. Of course, positive on HDFC AMC, given the kind of market share gains that HDFC AMC continues to clock. They are expecting a 18 to 19% EBITDA CAGR kind of number on HDFC AMC. On Nippon AMC also 21% CAGR, so that faster growth expected there. And last off, on UTI, they believe is losing market share. That's something that concerns them, just an 8% upside, more neutral on UTI AMC rather than the other two.
Interesting. Thanks for that, Harsh. Mayuresh, would you be a buyer into any of the asset management businesses or capital market businesses per se? Let's say brokerages are out because there are a lot of regulations around volumes. Would asset managers be the port of call?
Yes. And again, I think as Harsh was mentioning here, I think financialization of savings is a theme to be carried forward for over the next decade or so. And therefore, with the kind of accretions that are probably happening into their AUM growth, specifically equity-led, the expectation largely is that a lot of the operating costs that have got built up over the last decade or with new flows coming in, a large part of their business model is now skewed towards better bottom line growth in the next few years as well. And therefore, I think this entire space probably looks good. Even in our context at Markets with India, I think the EPS rating, institutional holding remains extremely strong. So yeah, I think optimistic and positive on this space. HDFC AMC, UTI AMC probably should remain on your watch list.
Another space which is doing fairly decently after quite a few days is realty. Realty stocks not half bad this morning, as at least in the pre-open session so far. Look at a Brigade, a Sobha, Phoenix, all of them had taken quite a bit of a knock. As some of the updates are coming in, Mayuresh, are you feeling some enthusiasm towards realty stocks?
Yeah, they should continue doing well, Tamanna, because if you probably look at the flow specifically in terms of how the top line has been growing, the enthusiasm in terms of the real estate cycle still exists. You're somewhere in the third or the fourth year in a 6 to 7 year cycle. And therefore, I think the additional tailwinds that might spur retail sales or even commercial sales to a large extent will be the interest rate cuts that happen in the domestic context at some point of time as well. The second element, obviously, is some risks in terms of inventory built up, specifically on the residential side. But in my opinion, again, I think it is still manageable to a large extent by these developers. And a lot of these developers are going for an asset-light route as well. So I think they are doing joint development agreements. And therefore, additional debt on their balance sheet is not increasing, creating significant amount of stability in cash flows as we head into the next few years as well. So I think interesting space. Anybody holding stocks like a DLF, Sobha, Godrej Property should continue.
Chandan, while we've talked to you about the index and metal stocks, anything that you're recommending for our viewers this morning?
So we have positive on the selective metal and the pharma name, looking at the price structure. So MCX is other name in capital market related names. So MCX has given a consolidation breakout of last 14 days. On weekly scale, it has been making higher top, higher bottom formation. Price structure with strong bullish candle clearly indicates further rally. So with support of 59.20, one can look for an upside target towards 6,200 kind of level. Positive on the selective pharma name. So we can focus on the counter like Divis Lab. A long consolidation breakout of last 18 days is happening here. Yesterday, it formed a strong bullish candle similar to perfect Modu Bozu or bullish belt where open and low was almost same. It gave the highest daily close. So with support of 5480, this counter can head towards 5800 zone. So I'll focus on MCX and most of the pharma name, and cannot forget the fashion related counter, whether we talk about Trent or ABFRM.
Kush, anything interesting you're spotting after the pre-open session?
In fact, even before the market opens, it's like an update. CRM Silk were discussed yesterday for a target of 5%. For the first target of 5%, the stock's actually opening at those levels. If you've got a position, keep a trailing stop loss and hold it. And then there is Ipca Labs, which we had suggested as a BTST. Even that is opening about 1% higher. So if you want to trade it as BTST, then might as well book profit. But if not, you could continue to hold. One other stock that's looking very interesting is Diamond Foods. Has had a good run in the last couple of sessions. I think from a near-term perspective, you're looking at an 1150 and a 1275 kind of a target, and your stop loss comes in at 1080. So Diamond Foods is something you want to keep on your radar for the day.
Diamond Foods is what you want to keep on your radar this morning. That's the word coming in from Kush. Mayuresh, very quickly, a trade on HDFC, ICICI and Kotak or even SBI, I'll throw that in. Do you think an intraday call on these stocks could be warranted today, a long trade?
Not sure about intraday, but from a long-term perspective, Samina, we continue holding ICICI and SBI in our global portfolios. Again, price action has been disappointing because of deposit mobilization issues for the sector as a whole. But let's see what RBI comes with. If there is some good news in terms of liquidity, and if the bank's management, specifically in terms of how they manage their treasury operations in these tough times, is something to reckon with. I think valuations and expectations of them creating good lower bases as we see in markets in India can be enablers. So ICICI SBI.
Okay, that's on banks. So 10 seconds left. We'll likely start off with a very bottom-up moves being seen in a clutch of stocks. Watch out for OMCs in particular because of the crude price fall. Is there a sharp bounce today or not? But about 0.25% in the green. Nifty IT should come up on your screen after the bounce back yesterday. Is it continuing that? Another 0.5% added, so not bad at all. Mid caps and small caps will come up on your screen next, just to see if the rally or what have you is extending. Yes, mid caps doing okay. Small caps doing okay too. This is not bad really, because this is not what you usually see if the rally is going to be short-lived. So good start. Let's see if this lasts. Bring up the heat map on the screen and let's see if BPCL tops the list. Yes, it does. 3.5% higher for that one. Tata Motors bounces back from yesterday's drubbing. SBI, Shriram Finance, Asian Paints. So crude sensitives likely starting off well. Bharti has a brokerage note as well in its favor. So watch out for that one. More green than red. What is not doing well? Nestle down. ONGC down, not surprising with crude prices coming off. But by the way, this might be temporary. There is weakness in HDFC Life after SBI Life's weakness in trade yesterday. JSW Steel continues to sulk. Hindalco continues to sulk. So metals are not quite out there. And just before Tamanna comes in, just keep this in mind that oil marketing companies are looking strong. Maybe pull up HPCL and IOC if we can just before I hand it over to Tamanna. Because BPCL is certainly starting off well. HPCL 5% higher, very strong move. And Indian Oil Corporation should come up on your screen. That one about 2.7% higher. So clearly, oil marketing companies are making their presence felt.
Yeah, absolutely. And that is one of the key stocks that we're tracking this morning. So not a bad continuation from yesterday's run-up is how you would put it. Definitely up on the positive side. Let's pull up the sectoral indices for a second and then your broader indices as well. Your PSU banks making an interesting comeback this morning. Oil and gas, as Niraj mentioned, on crude prices. A big slump in the Brent almost overnight, gone from $80 to $77 a barrel. Pharma stocks are doing fine. Metals continue to suffer. And little surprise there. Look at the Chinese markets right now, completely down in the dumps. So that pain reflecting on the metal index, but not too bad. Less than 0.5% down at this point. Broader indices also doing decently. But stock specific. Let's go stock specific. Let's start with Torrent Power. Orders over 1,600 crores, and this was, of course, on our watch list as well. That stock 6% up this morning, so one of the clear winners. We were talking about SKF. They're going to be demerging their operations. 6% up on that stock as well. Crude prices have cooled off, and Niraj mentioned it, but let's see what HPCL and IOC is doing now. 4.5% up, 2.5% up on IOC. And then, of course, it's all about the business updates. So many that have come in. Signature Global, positive. Phoenix Mills, not bad at all. 25% growth in sales year on year. Senco Gold has had astonishingly good same store sales growth. So that's 3% up as well. Ajmera has come in just a short while ago with their business updates, 4.5%. It's a day for reality. And IRB Infra, 19% increase in toll collections in the month of September. That's worked well for them. So I would say as spots of recovery, banks, definitely public sector banks, and smattering of real estate companies as well.
Some interesting movers in the broader markets as well. The breadth of the broader markets, not too bad. Yesterday it was the broader markets that led the way in trade and outperformed the benchmark itself. Bajaj Housing Finance is up 4%. I highlighted Torrent Power as the stock of the day, and it continues, or rather is a stock of the day. They've bagged a significant order, and the stock is reacting very well to that. It's up about 6% in trade as we see it. SKF India is likely to demerge, or rather is going to demerge its automotive and industrial units, on back of which the markets seem to be pleased. The stock trades the 5% gain. Niraj mentioned how well BPCL was doing, and usually they move in a block. HPCL following suit on lower crude prices or a rebound or a decline in crude. HPCL is reacting well with a gain of 4.5% as we see it. CDSL is looking good. You've got some of your pharma names. Divi's was up 3.5%. Was a stock pick by Chandan this morning. The counter actually looking fairly well placed. Along with HPCL, IOC also sees a gain of nearly 2%. So BPCL, IOC and HPCL are trading deeply in positive territory. Apart from that, pharma as a whole pack is looking good. So AstraZeneca is up 3%. Alembic is trading with a gain of 3%. Some small metal names aren't doing too badly. Senco is up 3% as well. Welspun Enterprise, while we are at it, they bagged an order too. Let's see if the markets are responding to that news flow. The counter is up 3%. This comes in after the stock made a 4% up move in trade yesterday and continues its journey on the way up. Auto not looking good yet. Ashok Leyland is seeing some weakness. 2.5% cut on Ashok Leyland is what we have. 197 Communications down this morning, down 3% as we see it. Metals are looking bad. Nalco is still trading with a 2% cut. Some of the mid-cap PSU banks are seeing some weakness. And all in all, it seems like a morning where it's not too bad. Extending yesterday's rally into trade today, but whether or not this is going to be sustainable is something we're going to have to watch. Chandan, you had a call on Divi's Lab. This was, of course, just before the markets open. It's already got a gap up of 3.5%. Now, for an individual trader who's not executed the trade, do you still recommend a long trade despite the fact that it's done 3.5% already in open?
Yeah, still I'm expecting momentum, and this stock can go till 7 to 8% up. That is 3 to 4% is still pending. Reason already I mentioned that Nifty Pharma is doing well, and somehow Nifty Pharma has given a breakout after the long consolidation of last almost 26 trading session, and Divis is one of the strongest setup in the pharma name, and I believe the price pattern itself indicate that momentum could continue. So one can hold. Now the support we need to revise, because after the opening now it's up by around 4%. So the morning low, which is near 56.50, can provide as a support cushion for the intraday momentum and raise the target to 59.50 to 6,000 marks in the Divis clip.
On account of the Citi note, Citi's initiated coverage on Divis with a buy rating and saying that a clutch of things are falling in place for Divis, including a $800 million pipeline till 2030. So watch out for that. Watch out for two stocks. Transformers and Rectifiers is yet again on an upper circuit. And SpiceJet is starting off very well yet again today after the 9% uptick. Another 5% added to that one. So keep an eye out for that. Kush, any thoughts here on SpiceJet? The bounce was very strong yesterday on a bounce back day, but continuing today, what does one do here?
So, Niraj, this is one for an aggressive trader. We've got a lot of other names to play with, but talking specifically for SpiceJet, I wouldn't go out and buy it just now because there's the 20-day moving average resistance that comes in. We know how volatile the stock is, and we all know what's happening with the business. So not very keen on a stock that is so volatile, especially when we've got very clear runs. But as far as the levels go, 62 or 61.50 thereabouts is the support zone. So if you've got a position, that's where you want to place your stop loss. If the momentum does continue, it could take it to 69 and then perhaps a 74 as well. So if you've got a position, continue to hold. Wouldn't recommend a fresh long addition on this one.
Let's just take a look at what's happening with Ashok Leyland. CLSA has a note out on it where they've downgraded it from outperform to underperform, and quite a steep downgrade on the target price as well. CLSA's target price is now 188 from 258 The reason is that they think the subdued demand and subsequent derating which has taken place, 10% decline in domestic truck sales signals a start of a CV down cycle. Mayuresh, just on autos, Hyundai IPO details now out. How are you looking at the entire auto space, and do you think CVs are going to be the joker in the pack?
That's a high possibility, Tamanna, and the expectation in terms of the CV stroke MCV stroke LCV market actually doing well over the next few quarters can be a high probability. The second element also to watch out for is the kind of infrastructure developments that are being done. So the last mile connectivity, as we call it, in terms of rural infrastructure, in real earnest is still on. And therefore, having the entire ecosystem as far as the CV players are concerned definitely come into play. Having said that, the expectations in terms of new norms kicking in will also probably aid the overall growth of this sector. And therefore, I think this is an interesting space within the entire auto bank. So yeah, anybody holding on to a stock like an Ashok Leyland should continue.
Right, that's Ashok Leyland. The stock is under pressure. 2.5% cut is what we are seeing. Along with that, a few other names that aren't doing too badly in the broader market, which we should look at is, we've talked about banks already, but Mayuresh, I don't know whether you've shared your views on PSU banks. Any opportunity here to nimble on the, the mid-cap broader market PSU basket of names, banking names?
So, Samina, I think Bank of Baroda has given a very decent update. What we continue holding in our global portfolios is Bank of Maharashtra. I think one differentiating factor when it comes to deposit mobilization is the legacy account holders with a lot of these PSU banks. And therefore, the deposit growth would continue at a decent pace, if not at a strong pace, considering what is probably happening in terms of macros. But I think the deposit pace will continue growing at a stable pace because of their legacy database. The second element, obviously, as we all know it, the balance sheet cleaning up has been pretty robust. And therefore, as write-offs have taken place over the last few quarters, as these recoveries start coming into the system, and all these bank managers are very, very positive on recoveries coming through, will directly add to the bottom line. Provision coverage is extremely strong and capital adequacy remains decent. So our take is Bank of Maharashtra, specifically from the mid-cap PSU basket, is something that we continue holding in a global portfolio.
Okay. Kush, a lot of interesting trends being spotted right at the opening. And just IT, I want to come to you on IT, and this is something that we spoke about as well. Bounce back from yesterday's levels, one day ahead of TCS numbers. Are you looking at the frontline IT companies right now, or are mid-caps looking better to you?
The mid-cap space is looking more interesting. A lot of the frontline names, like the TCS and Infosys and even HCL Techs of the world, Wipro doesn't really make the cut in the trading bet at least. But the likes of Persistent, LTI, Mindtree and Coforge, these are the names that are starting to show traction. They're hitting those resistance levels. Once that is taken out, you could see momentum also coming in. So if one were to bet, it would be, in one of these three names. And one more stock, I think, Niraj had visited their headquarters in Pune, which is KPIT Tech. It's now showing a bottom formation in place. And, if you're a medium-term investor, that's the stock that, you want to look at. And while we are at it, just a quick update on every stock that we had discussed in the closing show yesterday. And they'd be Lalpath Labs, M&M, CRM Silks and Ipca Labs. CRM Silk is up 5%. The first target was 525, second target 555. Now, the reason this one deserves a special mention is because the volumes at open on this one are humongous. We've seen a stellar run from those 460 levels in the last 3 sessions odd. But today, on the back of very good volumes, up 5% and gaining traction. I think if you've caught this one, you should put a trailing stop loss and ride this one to 555 and, higher levels.
Okay. A few of the others which are in focus this morning, and, I just want to ask Chandan specifically about HDFC Bank. Chandan, HDFC Bank, CLSA also a note out today, and it's fairly positive on it. Bank Nifty now losing quite a bit of its steam actually, and IT stocks are the ones that are roaring. But would you look at HDFC Bank at this level?
So HDFC Bank is one of the heavyweights theme in the Bank Nifty, and this index has managed to hold the lower levels on the last trading session, but follow-up is required. 51,250 is the level in Nifty Bank, which needs to surpass for some short covering trigger. And now talking about HDFC Bank, from last 3 days, even after the recovery, it has been finding sustained supply near 1659. Even yesterday, I was also in between that level and now taking hurdle at 50-day mark. So I just require a decisive hold above 1660. If it goes above 1660, then only I believe this immediate negative structure of the lower top, lower bottom will nullify for a bounce towards almost 1690 to 1700 zone. So there will be conditional trade above 1660 to buy SDFC Bank. And above this only it can give relief to the market and the bank Nifty as a whole. And I believe that trigger from the RBI policy might give some swing above these levels.
Something that should be watched out for. By the way, Chandan, understand we have to thank you. So take a moment to thank you for joining today. Really appreciate your time. But keep an eye out on banks for sure. Mayuresh, just come in here. If let's assume there is no rate cut, all right? Maybe there is a change of stance, what have you. But let's assume there are liquidity measures announced. And banks are struggling for that, right? They need liquidity. If that is done, could we see a spurt in the bank Nifty today, Mayuresh? Would you be a buyer into banks tactically if the Reserve Bank, if the MPC goes ahead and announces some liquidity measures?
So a two-part answer to your question, Niraj. If liquidity measures are announced, one thing to note is that what we've read from our reports is that there is already abundance of liquidity in the system. Now, what sort of short-term measures or medium-term measures does RBI adopt will obviously be a positive for the banks because of the entire deposit mobilization slowdown that we're probably witnessing. The second element is irrespective of what RBI does, from a valuation standpoint and from the base structures that these banks are creating at lower levels, I think this is one attractive pocket in the market which is still decent enough where the entire markets have probably moved in terms of valuations. So at some point of time, I think mobilization growth will normalize. They might probably, as I said, need to do some element of tweak in their treasury operations, maybe some element of tweak in their asset liability as well, considering some tenor increases, which might take a little bit of a hit in their NIMs and spreads. But that will be adjusted by the markets if the long-term growth probably remains intact. So generally, I think we remain optimistic on the banks. If liquidity measures are announced, yes, positive. ICICI Bank, State Bank are two large picks which remain part of our portfolio.
One space as well that's been languishing in the last few days has been consumption. And there's no relief rally playing out on the likes of an ITC or a Godrej Consumers that continue to sell off in trade today as well. Kush, I'll come to you on this one. What is going on here? I mean, the rebound you'd have imagined should play out on these counters as well, because they also sold off in terms of basket selling that we saw.
So what typically happens is that, when you've got the other sectors rallying, consumption takes a backseat. These sectors these stocks had actually moved quite a bit. But now when, some of these mid caps and other sectors start to look attractive, the FMCG or the consumption pack, broadly speaking, does sort of take a backseat. And I'm not surprised at that. ITC is in the consolidation zone, might continue to stay there. What I'm excited about are, a couple of names. One is United Spirits. If you look at that, the stock's taken support at the 50-day moving average, rebounding from there. So if you're, in this for, let's say, positional trade, then you could consider with your stop loss coming at around 1475 on the upside. 1550, 1600 also, very likely targets. Within the FMCG space in particular, we still continue to like Colgate. There's been consolidation, but that is after a very good run. So if you want to buy something, in the cash segment also from a medium-term perspective, Colgate is something that you should look at.
Guys, there's another interesting thing that I just thought we should talk about, because the last 2 days we've had two notes on Mahindra & Mahindra speaking about a possible uptick in the rural cycle, right? And the tractor cycle because of seasonal rains, etc.
That's the CLSA note.
CLSA note on M&M, and the day before there was another. Today, we got this MK note on Escorts, which is talking about the same thing. Escorts is up 3.5%. And I think one of the things that stood out for me, I don't know how the two of you think about it, was they are laying out this one particular observation that the previous 2 quarters and the current 2 quarters of FY25 have been very subdued. So everything else notwithstanding, the base effect for October to March and then subsequently from April to September next financial year is very favorable. So very likely that the reportage will be good, and on top of that, the cycle might actually revive because of the crop patterns, etc.
The Kharif season, yeah.
Wonder if this might actually be the turnaround point for tractors, while autos by and large don't look very attractive.
But that's the exact opposite of what, for example, CLSA is saying today on Ashok Leyland.
On Ashok Leyland, yes.
In terms of the commercial vehicle turnaround. But on tractors, I get your point, because then that rural recovery maybe is coming in. You've had a decent monsoon.
And a good base effect.
Yeah, and a good base effect. So
but I think quarter on quarter, this is not a very strong quarter for anything that's farm consumption, because...
Yeah, they are talking about starting October.
Yeah, so Q3. So Q3 onwards. So yeah, that's what you want to
And look at escorts today. It's up 3.5%.
There has been some movement. In fact, take a look at any of those other pesticide companies. I caught up with insecticides yesterday, and they were talking about how they would be expecting a pickup, but the demand, like we said, would be delayed, not in this quarter, but the quarter after, to see an improvement in the Kharif season. Well, apart from that, it's all eyes on the governor. In half an hour from now, we will have a policy decision, largely expected to remain status quo, but you are seeing some activity on banks that is continuing from yesterday. If I can just get the realty index up and see what is happening there too, should give us a sense of what the street is anticipating and working with, 1.5% higher. Chandan, you want to come in on real estate stocks? Any of them that look like a good trade at this stage? Okay, I believe Chandan's not with us, but Kush, why don't you tell us, what is the view on real estate stocks? Anything that looks like a good trading opportunity?
So Prestige seems to be making a good comeback after taking support at that 1700 mark. So that's one stock that you want to keep on your radar. We've liked Anantraj for some time now. Yesterday, I think it was about a 9.5-10% kind of a move. Today, also the stock is higher. There's this immediate resistance of the 750 mark. Once that is taken out, I think the stock could gain further momentum and head towards 820 as well. So Anantraj, from this space, broadly speaking, remains one of our top picks.
All right, so Anantraj, one of the top picks, real estate buzzing today, IT buzzing today, but not so much for the banks. Just, we came to you on the commercial vehicle side, Mayuresh, just wondering the conversation we had on tractors. Are you seeing that kind of a bump up? Are you feeling a little optimistic about this quarter for tractor makers?
Should be, Tamanna. And I was hearing Niraj and your conversations as well. I think there has been a good... monsoons have been decent, and therefore I think with reservoir levels remaining high, the expectation is that the sowing for the Rabi crop, the winter crop, should be equally good as well. Now let's break this up very quickly in 30 seconds. I think the land ownership, 90%, is less than 1 hectare, and therefore I think tractor makers have to be very, very innovative as far as India is concerned. Anything below 30 or 40 horsepower is something that is good to work in the Indian context, which both Escorts and M&M are probably doing. Escorts to Kubota is probably getting a lot more in terms of the 15, 20, 30 horsepower kind of tractors, which are power efficient and price efficient as well. And therefore, as these models keep on getting introduced in the Indian context, and it also becomes a hub for export opportunities as far as global markets are concerned, I think tractor makers should probably remain in a very, very sweet spot.
Okay, tractor makers will be in a sweet spot. I don't know how you're feeling about the Hyundai IPO, Mayuresh. Just one call on that. The details that you may have seen on the DRHP so far, and how does that make you feel safe about a Maruti or a Tata Motors?
I think Hyundai's parent is going to make a killing, Tamanna, and the FOMO that exists in the markets, I think I'm pretty sure the IPO will be subscribed pretty strongly. Obviously, I think there are concerns with such huge IPOs coming in, including the Swiggy one. Liquidity will get sucked out. But let's see how that happens, I think. And at least at this juncture, looking at the oversubscription numbers for even the smaller SMEs or the other IPOs coming through, I think this should not create so much of an issue. Maybe some element of volatility around the IPO time. But again, with Hyundai coming in, the numbers have been pretty impressive so far as the overall growth trajectory is concerned. But let's not take away from the fact that Maruti has a huge distribution network. They're introducing new models in the next few quarters as well. After sales distribution is equally important in the auto industry as well. And therefore, I think still continue to remain positive on Maruti.
Right, stay positive on Maruti and this massive IPO that's going to hit the street, which will potentially squeeze out some liquidity, like Mayuresh said, from the secondary markets. Kush, Mayuresh, thank you. Have a good week, the rest of the week rather, and we'll see you soon. Well, it's the season of provisional updates, numbers coming in from companies, and we had Signature Global that reported their numbers, the provisional numbers, like I said. The real estate developer has reported a 184% jump in pre-sales, amounting to 278 crores. quarter on quarter, the numbers soft, but that's largely the case across the industry because Q2 remains to be rather soft for the sector. Rajat Kathuria, CEO at Signature Global, now joins in. Rajat, hi, good morning. Thanks for joining in. Year on year, we've seen a massive jump on pre-sales. Collections have also improved significantly. Q on Q, of course, it is soft, but from what I understand, this is an industry phenomena. You want to walk us through what went beyond these numbers, which projects have seen traction, and how are things looking?
So thanks for inviting us to your show. So we saw very good traction around one of our projects in Sona, which we launched just towards the end of the last quarter. So that project, within a span of, let's say, 10 days, I think saw tremendous response. We sold quite well in that project despite the Shraddh period going on. So by and large, the story remains the same, that as new projects are being launched, we are seeing very good traction and absorption from customers around these projects. So the way we look at it is that if you look at the trailing 9 months, as in starting January of this calendar year, we are kind of almost nearing that 3,000 crore per quarter sales, whether it was the last quarter of the previous year, financial year, or these 2 quarters. I think we are seeing consistent trend in the market.
Let's talk about this significant project that you referred to, Sona. And when you launched it, it was supposed to garner a potential revenue of 5,000 crores. How much have you achieved so far from this project specifically? And is there any possibility of, and when do you plan to achieve that 5,000 crore number? Do you still maintain that? And when would you achieve that?
So we'll eventually achieve much higher than 5,000 crores from this particular project. It's upwards of 7,000 to 8,000 crores is what we tend to achieve out of this project. We just got 10 days of launch period, and we achieved more than 2,000 crores of revenue within the short span of 2,000 crores from this particular project.
Rajat, hi, good morning. Tamanna here. Just wondering, wondering what your FY25 target is looking like in terms of launches. You had a hefty one at 16,000 crores. Is that now on track? And then what's the picture for H1?
So, see, we are on track, Tamanna. I think by December of this year, we would have done that. Most of those, or we may have crossed, that 16,000 odd crores of launches, which we tend to do during this financial year. So we are on track of our launch pipeline for this year.
And have you seen Q2, the industry sort of mood coming in is that Q2 has been a little softer. Have you seen that at all, overall, in the kind of demand? No.
No, not at all.
It's been quite the reverse.
Yeah, not at all.
Okay. In terms of MMR launches, inventory, what is the kind of outlook that you have?
So, see, we are launching projects in Gurgaon, and if we look at the entire decade of experience, the situation is that as we are launching projects, it's getting absorbed. We see no change in that trend. Market is hugely supply constrained. Gurgaon, anyways, is a new city which has really taken a center stage in the NCR real estate market over the last, decade or 15 years, you may say. There is a lot of supply constraint. We are just trying to fulfill that huge demand which exists. And there is no softening whatsoever because even if you look at this Sona project, we literally 10 days, we've achieved more than 2,000 odd crores of sales. If we had like a full month to sell the project, maybe, we would have even lost our last quarter's sales performance. But given that we've entered this auspicious, season of Diwali and festivals, we feel that a lot of sales, will continue to, happen during this quarter as well.
Rajat, good morning to you. Just wondering, we always talk about this point that pre-sales look very, very strong. Not necessarily that collections are that strong. I mean, they're good. 28% is a good number. Nowhere close to the pre-sales number. I'm just trying to understand how would these pre-sales translate into actual collections over the second half? Because I think it will depend on the pace of the execution that you outlined for yourself, right? So how would that work in the second half? Because your first half pre-sales have gone bonkers, really.
So, Niraj, there are a couple of factors one should look at while looking at collections vis-a-vis pre-sales. Is the fact that how much of the land on which we are doing projects is owned by the company. Signature Global has always had this philosophy of working on land which is owned by the company, and we've not, as a preference, we've not gone out and done collaboration agreements with landowners. In case projects are sold with time-linked or construction-linked plans and land is primarily owned by the company, the pre-sales converts into collections. That's been our trend as well over the last many years, that as pre-sales have grown, collections have grown in tandem with pre-sales. We are very confident for this year with regard to our pre-sales and collections target of 10,000 crores and 6,000 crores respectively, that we should be able to achieve both of these targets for the entire fiscal year.
Got it. Okay. So, we'll address those flashes. But Rajat, just one quick question, and then we'll get an industry conversation going, because we also have Purvankara joining in. So I'd urge you to stay on if you have the time. But just one more Signature Global specific question. You safely are on target for FY25, I presume, based on what you told us the last time too. Are there projections that you now comfortable giving for FY26 based on the pre-sales that you've already done? It may not be a formal guidance, but just a thought around what the numbers could look like or the growth could look like.
See, I can't be talking of the exact guidance, but the philosophy and, our thesis is that on an annualized basis, in the kind of market dynamics we are in, to assume 20 to 25% growth on an annualized basis is something which is very achievable. So let's see what we close out this year with for the full year, basis which we'll roll out the formal guidance for the coming year.
FY25, since you are saying you'll cross 16,000 crores in December itself, that number goes up?
16,000 crores in terms of launches, Tamanna. For the full year, we had given a guidance of 10,000 crores. We've already achieved close to 60% of that annual guidance. We feel comfortable with that annual guidance being achieved.
Live pictures coming in here of Governor Shaktikanta Das arriving at the RBI headquarters. Will we see an interest cut? Unlikely. But the interesting thing about the real estate industry is that despite no cuts in sight, they have not really seen too much of a problem as far as demand is concerned. So Rajat Kathuria, of course, continues with us. He's CEO at Signature Global, but we're also joined now by Abhishek Kapoor, Group CEO at Purvankara. Abhishek, great to have you on the show as well. And since, we're talking in the context of the monetary policy, we'll hear from the governor in about 15 minutes from now. Just trying to understand what impact, if any, the interest rate cycle is going to have. We might have a rate cut by December. Does that bode well for you?
Good morning, and thank you for having me on the show. Definitely, yes. You look, current interest rates have had no impact on the demand. As we see currently, we believe that the current interest rate environment is good for the real estate industry per se, but a reduction will definitely have a positive impact on the demand side as well as overall on the industry side.
Okay. And just a quick word from you, Rajat, on the monetary policy side of it and what expectations you have, if any.
So I think let's just wait to hear the governor. No expectations per se. I agree to Abhishek that there is so much of demand that interest rates per se at the current levels not having any negative bearing on the demand side. And there's this confidence amongst customers that interest rates not going up from here. A lot of people are assuming that going forward they can only come down, which is giving them confidence while making the purchase and taking mortgages.
Abhishek, hi. It's also Samina joining in. Let's start talking about a little more company-specific news flow that we have. You've acquired a pretty significant piece of land in North Bangalore to the tune of about 3 acres. You want to share with our viewers what is the gross development value of this project and when can we expect it to come on stream?
Look, I'll give you overall perspective of what's happened during the year. So for us, we have added about 6+ million square foot of overall area in new business development that we have done across India. With a GDV of almost 12,000 crores. If you look at last year's number, we have sold about 7.26 million square foot. And if you look at what the plan is for this year, we're looking at launching about 12+ million of new projects and about 4 million square foot of new phases of the old project, totaling to about 17 million square foot. So keeping that in mind and the volumes we are doing our business development. Of course, North Bangalore project, which you asked about, is a 3+ acre project, and that's a residential development we are looking at doing with a GDV of 700+ crores. So on an overall basis, I think the target for us, and this is just the H1 of this year, is to continue to robustly add to our pipeline of business, keeping in mind the next financial year's growth plan as well.
Before we go on to that, you want to share with me what is the target you've set out for Puravankara in terms of sales for FY25, and where do we stand at? How much has been accomplished already?
Look, we don't give the sales value guidance, but as I said, what we have planned and which we have announced is 12+ million square foot of new projects which will come to the market. Most of those projects are in fact coming into the market in the third and the fourth quarter possibly being the largest, and that is typical industry cycle any which ways. In the first quarter itself, we sold about 1.2 million square foot, resulting into about 1,128 crores of sales. For the second quarter, we are yet to make the announcement on the pre-sales number, which is expected towards the end of this week. So, on an overall basis, we are quite happy. We see positive momentum in the second quarter, like always, and we will see better momentum in the third and the fourth quarter, which is largely on the back of new launches. I think, I kind of agree what earlier was discussed in terms of the gap today is of the launch and of what supply is we are able to bring to the market for a strong branded player. So I think we are on the same track. We're expecting launches in the third and the fourth quarter, and therefore we will see how that goes.
Just, want to get a sense of the kind of the industry-wise. Let's go a little industry-wise right now, Abhishek, and let me come to you on this. Maybe not specifically to Puravankara, but there is a sense that we are looking maybe at a bit of a go easy on new launches and on bookings. Are you seeing any of that happening, or are you expecting the festive season to change that mood and Q2 would anyway have been softer?
Look, I don't think Q2 has been softer. I think Q2 was better than Q1 for sure, overall for the industry. And I would expect, as the typical industry cycle, given that today, if you look at the inventory levels across the country, they aren't significant at all. I mean, more or less, it's less than a year, and that continues. On ground, what we're seeing on demand side, we are not seeing any letup. I think the branded strong players will continue to see traction in the coming 2 quarters. And I'm anticipating that, whatever as an industry we see as a growth, we will achieve that. On the other hand, on the price, I think the industry has reached where, we will see inflation plus 2 or 3% average incremental price appreciation, which means that, the inflationary impact of costs which were to be absorbed or passed on to the consumers because of the inflationary pressure in the past has already been taken into account. So we don't see any major increases because we're not seeing any major increase in the commodity prices. Of course, we have to wait and watch and see what happens. But on an overall basis, I think we'll see high single digits, inflation plus 2-3% increase. But of course, project to project, you will see much larger differences depending on what the cycle of the project is or stage of the project is. But on an overall basis, as I said, I think the demand continues to be robust.
Rajat, one quick question, and we very often, when we talk about real estate and the company, we are so focused on pre-sales, collection, and of course the top line, is that we forget to talk about what's happening on the bottom line. There's clearly an increase in raw material cost. How is that impacting your bottom line?
So, Tamanna, the increase in the commodity prices, or let me put it reversely, that increase in the end product price has been higher than the increase in the landed commodity price. That's at least been the trend in our local market over the last 2 to 3 years. And hence, we don't, foresee an impact on the bottom line vis-a-vis the increase in the cost of production.
Okay, so net, just one set of questions from my end. If indeed there are liquidity easing measures, if indeed it is dovish commentary from the Reserve Bank today, and if indeed we almost believe that there is going to be a rate cut in the next policy, I want to understand if sales get impacted at all, or would sales effectively be linked to the economic factors and not necessarily a 25 basis point rate cut or liquidity measures. Rajat, this first to you and then Abhishek to you.
So, Niraj, any kind of rate cut is a big welcome for the industry because, it adds to the optimism and momentum, and it helps in decision making of the customer that, we are getting into the rate cut cycle. So even if there's a 25 bips rate cut, people would assume that over the next 1 year, we can see 50 to 75 bips sort of a rate cut, and hence it will ease the decision making of a lot of families. What we need to understand is that whether we look at Bangalore or we look at the Delhi NCR market, there are almost lakhs of families which are getting added to the bracket where they can go ahead
think of buying a home.
Take a mid-income housing purchase. It really helps in the decision making.
Fair point. Okay. Fair call, Rajat. Abhishek, do you believe that too? I mean, normally people with 25 basis points will not really matter that much.
Niraj, I agree with Rajat. I think the demand is robust. I think it is very, very much economy and, the economic cycle that we are in and that activity we are seeing. It's dependent on that, and we are continuing to see that demand come into the market. So I don't think there'll be any meaningful impact. I think we'll continue to see growth in sales as we have seen earlier. Yes, the only thing, as I agree with Rajat, is that it possibly might help the people to take decisions, make it easier or make a larger purchasing decision, because it also directly impacts the affordability of an individual, because the interest cost is directly linked to the affordability of how much loan can be given to a buyer. So I think in that sense, it will be helpful. And of course, given that it's a start of rate cut cycle, we believe that in next couple of years, general direction seems to be that there will be a further rate cut. So overall, it'll be positive, but I think it's really, really economy driven. And that's how you've seen in the past, even with the increasing interest rates, we haven't seen any impact or let up in demand.
All right, gentlemen, both of you, thank you so much for taking the time out and being with us. Really appreciate your time this morning. Let's hope for a good policy. And in fact, that is what we focus on. It's a wrap on India Markets Open. Up next, we focus on the MPC decision. Stay tuned to NDTV Profit.
we're counting down to the RBI monetary policy, and expectations are that you will have no change in interest rates for the 10th consecutive time. No real indication that you might be surprised either, but this is still a very interesting and important policy to watch in terms of what the governor will say, because it comes on the back of the big rate cut from the US Federal Reserve, which was being awaited for a long time. That is, in a sense, the lever for India to start cutting rates as well. The question is not if, but when. Unlikely to be in this policy. Nevertheless, Niraj, I would say that this policy becomes crucial in terms of the commentary which comes in from the governor. Some questions there on economy and economic growth, those perhaps could be quelled today.
Yeah, I concur completely. I mean, actually, that is the crux of the policy. I'm just very interested in knowing if indeed liquidity measures come in. Also very interested in Tamanna talking to Jayesh Mehta after the policy, because he was the one who was saying that October is firmly on the table. It'll be very interesting to see what his takeaway is if there is no rate cut, and very likely there won't be, but depending on the liquidity measures that are put out.
You know, I think the other big factor to look at is what is the central bank going to do here in India, considering all the aggressive moves coming in from China. China right now moving on the fiscal front, on the policy front, aggressively on rates as well. So can India afford to, I think one key question in my mind right now is, can India afford to be in that sense a little quote-unquote complacent and say, okay, we're marching to our beat, we have our own thing going on, but you have US and China acting very, very aggressively to boost their economies. You're seeing that in the kind of outflows we've seen, and okay, you can link that to equity markets, but 46,000 crore of outflows have gone off in the last week from India. So are you going to see some indication of letting loose? I don't know. That's one definitely to watch out for.
Clearly. So two things, viewers, I guess, right? I think what both me and Tamanna are trying to say. Two things. One, liquidity measures, if they come about. And two, commentary possibly more important than action, because in action there might not be too much. So is the commentary going to be a bit more dovish than what the street believes? Could that give a leg up to financials in the session today? I think that's the other big thing to watch out for. Remember, viewers, that the era, Tamanna, is slightly different in that if everybody believed that with the first rate cuts coming in from the Fed, that there's going to be a series of rate cuts, the US data seems to suggest that it may not be a series. It may be a very idiosyncratic move on the US part as well, every single time they meet. So
Namaskar.
It's going to be a...
Season's greetings to each one of you. This is the 51st meeting of the Monetary Policy Committee, that is the MPC, and this is how it goes. The flexible inflation targeting framework has completed 8 years since its introduction in 2016. This is a major structural reforms of 21st century India. It stands out for its committee approach to decision making, transparency of policy making process and communication, accountability hinging upon quantitatively defined inflation target, and operational independence. Over the years, the framework has matured across various interest rate cycles and monetary policy stances. When I look back, I can say with confidence that the flexible inflation targeting has served us well over the years and has proved its mettle. It brought about an era of price stability in the pre-COVID-19 period, with inflation averaging around the target rate of 4%. Thereafter, despite continuing global turmoil from multiple sources in the last 4 years or so, the flexibility embedded in the flexible inflation targeting framework has helped us to effectively address these unprecedented challenges while supporting growth. Monetary policy in India was able to respond to the economic slowdown decisively and swiftly in the wake of the COVID-19 pandemic, and again preemptively during the buildup of inflationary pressures after the war began in Ukraine in early 2022. The prevailing well-balanced growth inflation dynamics is indeed a testimony to the success of this monetary policy framework. Let me now turn to the decisions and deliberations of the Monetary Policy Committee. The Monetary Policy Committee met on, and this time, as you would be aware, this time we have 3 new external members in the MPC. The Monetary Policy Committee with 3 new external members met on 7th, 8th and 9th October. And after assessing the evolving macroeconomic and financial conditions and the outlook, the MPC decided by a majority of 5 out of 6 members to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is the SDF rate, remains at 6.25%, and the marginal standing facility, that is the MSF rate and the bank rate, they stand at 6.75%. Further, the MPC decided unanimously to change the stance, that is the stance of the monetary policy, to neutral, and also decided to, let me read it again, the MPC decided unanimously to change the stance to neutral and to remain unambiguously focused on a durable alignment of inflation with the target while supporting growth. The MPC noted that currently the macroeconomic parameters of inflation and growth are well balanced. Headline inflation is on a downward trajectory, though its pace has been slow and uneven. Going forward, the moderation in headline inflation is expected to reverse in September and likely to remain elevated in the near term due to adverse base effects, among other factors. Food inflation pressures could see some easing later in the financial year on the back of strong Kharif sowing, adequate buffer stocks and good soil moisture conditions, which are conducive for Rabi sowing. Adverse weather events continue to pose contingent risks to food inflation. Core inflation, on the other hand, appears to have bottomed out. Fuel component of the CPI remains in contraction. Domestic growth has sustained its momentum with private consumption and investment growing in tandem. Resilient growth gives us the space to focus on inflation so as to enable its durable descent to the 4% target. In these circumstances, the MPC decided to remain watchful of the evolving outlook in the coming months. Keeping in view the prevailing inflation and growth conditions and the outlook, the MPC considered it appropriate to change the stance to neutral and to remain unambiguously focused on a durable alignment of inflation with the target, while of course supporting growth. I would now turn to an assessment of the growth and inflation situation. First, let me talk in brief about the global growth conditions. The global economy has remained resilient since the last meeting of the MPC in August. Although downside risks from increasingly intense geopolitical conflicts, geoeconomic fragmentation, financial market volatility, and elevated public debt continue to play out. Manufacturing is showing signs of slowdown while services activity is holding up. World trade is exhibiting improvement. Inflation is softening, supported by lower energy prices. Growing divergence in inflation growth dynamics across countries has resulted in varying monetary policy responses. Let me now turn to domestic growth. Real GDP grew by 6.7% in the first quarter of this financial year, that is 24-25. And this was led by a revival in private consumption and improvement in investment. The share of investment in GDP reached its highest level since 2012-13. Government expenditure, on the other hand, contracted during the first quarter. On the supply side, gross value added, that is GVA, expanded by 6.8%, surpassing the GDP growth, aided by strong industrial and services sector activities. High-frequency indicators available so far suggest that domestic economic activity continues to be steady. The main components from the supply side, that is agriculture, manufacturing, and services, they remain resilient. Agricultural growth has been supported by above normal southwest monsoon rainfall and better kharif sowing. Higher reservoir levels with good moisture conditions of soil augur well for the ensuing Rabi crop. Manufacturing activity is gaining on the back of improving domestic demand, lower input costs, and supportive policy environment from the government. 8 core industries output fell by 1.8% in August on a high base. Excess rainfall also dampened the production in certain sectors such as electricity, coal, and cement in August. The Purchasing Managers Index, that is PMI for manufacturing, at 56.5 for September remained elevated. The services sector continues to grow at a strong pace. PMI services at 57.7 in September indicates robust expansion. On the demand side, rural demand is trending upwards while urban demand continues to hold firm. Government consumption is improving. Investment activity remains buoyant with government capex rebounding from a contraction observed in the first quarter of this year. Private investment also continues to gain steam on the back of expansion in non-food bank credit, higher capacity utilization, and rising investment intentions. On the external front, services exports is supporting overall growth. Looking ahead, India's growth story remains intact as its fundamental drivers, namely consumption and investment demand, are gaining momentum. Prospects of private consumption, the mainstay of aggregate demand, look bright on the back of improved agricultural outlook and rural demand. Sustained buoyancy in services would also support urban demand. Government expenditure of the center and the states is expected to pick up pace in line with the budget estimates. Investment activity would benefit from consumer and business optimism, government's continued thrust on capex, and healthy balance sheets of banks and corporates. Taking all these factors into consideration, real GDP growth for 24-25 is projected at 7.2%, with Q2 at 7%, Q3 at 7.4%, and Q4 7.4%. Real GDP growth for Q1 of next financial year, that is 25-26, is projected at 7.3%. The risks are evenly balanced. I would now like to turn to inflation. Now, as anticipated, headline inflation softened significantly in July and August, with base effect playing a major role in the month of July. Food inflation experienced a certain degree of correction during these 2 months. Considerable divergence, however, was observed within the food subgroups. Now, whatever I am saying, I have given a lot of data in the footnote of my statement, which as usual will be uploaded in the RBI website immediately after my statement is, immediately after I complete my statement. For example, I just now said that considerable divergence, however, was observed within the food subgroups. So this is backed up by the data which I have given in the footnotes. And in fact, all the statements that I am making are backed up by supportive data there in the footnotes. So those of you who are interested may like to have a look at them after it is uploaded. Now, deflation in fuel group deepened on softening electricity and LPG prices. Core inflation, on the other hand, edged up in July and August. The CPI print for the month of September is expected to see a big jump due to unfavorable base effects and pick up in food price momentum. And this would be caused by the lingering effects of a shortfall in production of onion, potato and chana dal, that is gram, in 2023-24, among other factors. The headline inflation trajectory, however, is projected to sequentially moderate in Q4 of the current financial year due to good kharif harvest, ample buffer stocks of cereals, and a likely good crop in the ensuing Rabi season. Unexpected weather events and worsening geopolitical conflicts continue as major upside risks to inflation. International crude prices have become volatile in the month of October, that is in the current month. The recent uptick in food and metal prices, and this is very important, the recent uptick in food and metal prices as seen in the FAO, that is Food and Agricultural Organization, and the World Bank price indices for September, if sustained, can add to the upside risks to CPI inflation. Taking into account all these factors, CPI inflation for 2024-25, that is for the current year, is projected at 4.5%, with Q2 at 4.1%, Q3 at 4.8%, and Q4 at 4.2%. CPI inflation for the first quarter, that is Q1 of next financial year, that is 2025-26, is projected at 4.3%. The risks are evenly balanced. Now, I have summarized our assessment of the domestic growth and the inflation conditions and the outlook as per our assessment. Now, what do this raises the question, what do these inflation and growth conditions mean for monetary policy? The developments since the last meeting of MPC in August indicate further progress towards realizing a durable disinflation towards the target. Despite the near-term upsides to inflation from food prices, the evolving domestic price situation signals moderation in headline inflation thereafter. The agricultural crop outlook is turning out to be favorable, with improving prospects of Kharif and Rabi output. These factors could lead to an easing of food inflation pressures, but this optimism is subject to weather-related shocks, if any. Core inflation is likely to remain broadly contained on continuing transmission of past monetary policy actions, unless, of course, there are surprises in global commodity prices. The prevailing and expected inflation growth balance, please mark my words, the prevailing and the expected inflation growth balance have created congenial conditions for a change in monetary policy stance to neutral. Even as there is greater confidence in navigating the last mile of disinflation, significant risks, I repeat, significant risks to inflation from adverse weather events, accentuating geopolitical conflicts, and the very recent increase in certain commodity prices continue to stare at us. The adverse impact of these risks cannot be undermined, cannot be underestimated. It's with a lot of effort that the inflation horse has been brought to the stable, that is closer to the target within the tolerance band compared to its highest or heightened levels 2 years ago. We have to be very careful about opening the gate, as the horse may simply bolt again. We must keep the horse in tight leash so that we do not lose control. Going forward, we need to closely monitor the evolving conditions for further confirmation of the disinflationary impulses. I would now like to turn to the liquidity and financial market conditions. System liquidity remained in surplus during August and September, and also in early October, with a pickup in government spending and decline in currency in circulation. Liquidity conditions, however, had turned into deficit for a brief period during the latter half of September, with the buildup of government cash balances on account of tax-related outflows. In sync with the shifting liquidity conditions, the Reserve Bank proactively conducted two-way operations to ensure alignment of interbank overnight rate with the policy repo rate. Across the term money market segments, the yields on 3-month treasury bills, that is T-bills, and commercial papers issued by non-banking financial companies, that is NBFCs, eased, while that on certificates of deposits firmed up marginally. The 10-year G-Sec yield softened in August-September on global and domestic cues, including policy pivot in the United States and also in some major economies. And also, these are not the only factors, but the yields in August-September, I'm talking about the 10-year G-Sec yields, they softened somewhat in August and September due to multiple factors, which would include pivot in the monetary policy of the US and some major economies, improved global investor sentiment, benign domestic inflation, and accelerated fiscal consolidation. The term premium, that is 10-year G-Sec yield minus 3-month T-bills yield, has remained stable in the recent few months. Transmission to the credit market has been satisfactory. Moving forward, the Reserve Bank will continue to be nimble and flexible in its liquidity management operations. We will deploy an appropriate mix of instruments to modulate both frictional and durable liquidity so as to ensure that money market interest rates evolve in an orderly manner. During the current financial year, that is up to 8th of October, that is till yesterday, the exchange rate of the Indian rupee has remained largely range-bound. The Indian rupee also continued to be the least volatile among peer EME currencies. This was so even during the high volatile episode following the unwinding of the yen carry trade in early August this year. The lower volatility of the Indian rupee reflects India's strong macroeconomic fundamentals and improved external sector outlook. I would now turn to financial stability. The health parameters of banks and NBFCs in India continue to be strong. There has been some recent commentary on the likelihood of stress buildup in a few unsecured loan segments like loans for consumption purposes, microfinance loans, and credit card outstandings. The Reserve Bank is closely monitoring the incoming information and will take measures as may be considered necessary. Banks and NBFCs on their part need to carefully assess their individual exposures in these areas, both in terms of size and quality. Their underwriting standards and post-sanction monitoring have to be robust. Continued attention also needs to be given to potential risks from inoperative deposit accounts, cybersecurity landscape, mule accounts, and a few other factors which we have been stressing and highlighting time and again in the public domain as well as in our interaction with the banks and NBFCs. Now, overall, I would again like to stress that our banking and the NBFC sector, that is the financial sector, remains healthy, resilient, and stable. NBFCs in particular have registered an impressive growth over the last few years. This has resulted in more credit flow to remote and underserved segments, bolstering financial inclusion. While the overall NBFC sector remains healthy, let me re-emphasize, while the overall NBFC sector remains healthy, I have a few messages to certain outliers. First, it is observed that some NBFCs are aggressively pursuing growth without building up sustainable business practices and risk management frameworks. which should be commensurate with the scale and complexity of their portfolio. An imprudent growth at any cost approach would be counterproductive for their own health. Second, driven by significant accretion to their capital from both domestic and overseas sources, and sometimes under pressure from their investors, some NBFCs, including microfinance institutions and housing finance companies, are chasing excessive returns on their equity. While such pursuits are in the domain of the boards and managements of NBFCs, concerns arise when interest rates charged by them become usurious and get combined with unreasonably high processing fees and frivolous penalties. These practices are sometimes further accentuated by what appears to be a push effect as business targets drive retail credit growth rather than its actual demand. I'm not generalizing it for the whole NBFC sector. There are certain NBFCs where it is happening. Bilaterally, we are engaged with them, but I think this is a message which it's important not only for these outliers to keep in mind, but I think this should act as a guidance for the entire sector. Now, the consequent high cost, I was talking about the push effect, that is business targets driving retail growth rather than its actual demand. In that context, I would like to say that the consequent high cost and high indebtedness could pose financial stability risks if not addressed by these NBFCs in time. Third, NBFCs may review their prevailing compensation practices, variable pay, and incentive structures, some of which appear to be purely target-driven in certain NBFCs. Such practices may result in adverse work culture and poor customer service. To sum up, it is important that NBFCs, including MFIs and housing finance companies, follow sustainable business goals, a compliance-first culture, a strong risk management framework, a strict adherence to fair practices code, and a sincere approach to customer grievances. The Reserve Bank is closely monitoring these areas and will not hesitate to take appropriate action if necessary. Self-correction by NBFCs would, however, be the desired option. Coming to external sector, India's current account deficit, that is CAD, widened to 1.1% of GDP in the first quarter of this financial year, that is 24-25, and this was on account of higher trade deficit. Buoyancy in services exports and strong remittance receipts are expected to keep the current account deficit within the sustainable level. On the external financing side, foreign portfolio investment, that is FPI flows, have seen a turnaround from the net outflows of $4.2 billion in April and May this year. They have turned from net outflows. In April and May, we had net outflow of $4.2 billion. Now they have now turned to net inflows of $19.2 billion during June to October, and this is the figure till 7th of October. Foreign direct investment, that is FDI flows, remain strong in 24-25 as both gross and net FDI flows have improved in April and July. While external commercial borrowings moderated, non-resident deposits recorded higher net inflows compared to last year. India's foreign exchange reserves have already crossed a new milestone of $700 billion. Overall, India's external sector remains resilient as key external sector vulnerability indicators continue to improve. And when I say key external sector vulnerabilities continue to improve, I have backed it up by the data in the footnote of the statement. On the whole, we remain confident of meeting our external financing requirements comfortably. I shall now announce certain additional measures. The first relates to responsible lending conduct, levy of foreclosure charges, and or prepayment penalties on loans. The Reserve Bank has taken several measures over the years to safeguard consumer interest. As part of these measures, banks and NBFCs are not permitted to levy foreclosure charges or prepayment penalties on any floating rate term loan sanctioned to individual borrowers for non-business purposes. That is, for purposes other than business. It is now proposed to broaden the scope of these guidelines to include loans to micro and small enterprises, that is MSEs. A draft circular in this regard shall be issued for public consultation. The second announcement relates to discussion paper on capital raising avenues for primary urban cooperative banks, that is for UCBs. The Reserve Bank has undertaken several initiatives in recent years to strengthen the UCB sector. Such initiatives include issuance of regulatory guidelines in 2022 for issue and regulation of share capital and securities by the urban cooperative banks. To provide more flexibility and avenues to the UCBs, that is urban cooperative banks, to raise capital, a discussion paper on capital raising avenues for UCBs will be issued for feedback and suggestions from stakeholders. The third announcement relates to creation of Reserve Bank Climate Risk Information System. Climate change is emerging as a significant risk to financial system world over. This makes it necessary for regulated entities to undertake robust climate risk assessment, which is sometimes hindered by gaps in high-quality climate-related data. To bridge these data gaps, the Reserve Bank proposes to create a data repository, namely the Reserve Bank Climate Risk Information System, or in short RB-CRIS, Reserve Bank Climate Risk Information System, that is RB-CRIS. The next announcement relates to UPI, where we are enhancing certain limits for the various transactions. UPI has transformed India's financial landscape by making digital payments accessible and inclusive through continuous innovation and adaptation. To further encourage wider adoption of UPI and make it more inclusive, it has been decided first to enhance the per transaction limit, in UPI 123 Pay from rupees 5,000 to rupees 10,000. And second, it has also been decided to increase the UPI Lite wallet limit from rupees 2,000 to rupees 5,000 and per transaction limit from rupees 500 to rupees 100. The final announcement relates to introduction of beneficiary account name lookup facility. Let me explain what it means. At present, UPI and Immediate Payment Service, that is IMPS, provide a facility for the remitter of funds to verify the name of the receiver of the funds, that is the beneficiary, before executing a payment transaction. It is now proposed to introduce such a facility for RTGS as well as the NEFT systems. This facility will enable the remitter to verify the name of the account holder before effecting funds transfer to him or her through RTGS or NEFT. This facility will also have the effect of reducing the possibility of wrong credits and frauds. Let me now conclude. Today, the Indian economy presents a picture of stability and strength. The balance between inflation and growth is well poised. India's growth story remains intact. Inflation is on a declining path, although we still have a distance to cover. The external sector demonstrates the strength of the economy. Forex reserves are scaling new peaks. Fiscal consolidation is underway. The financial sector remains sound and resilient. Global investor optimism in India's prospects is perhaps at its highest ever. We are, however, not complacent. I repeat, we are not complacent, especially amidst the rapidly evolving global conditions. The monetary policy action today reflects the MPC's assessment that at the current juncture, it would be appropriate to have greater flexibility and optionality to act in sync with the evolving conditions and the outlook. We stand unambiguously committed to ensure durable alignment of inflation with the target while supporting growth. In the prevailing macroeconomic conditions and the outlook, Mahatma Gandhi's words remain highly relevant. And I quote, "When the method is good, success is bound to come in the end." Thank you. Namaskar.
All right, so I think it ticked all the boxes. The biggest takeaway, because the fact that there's going to be no rate change was expected, but the biggest takeaway is truly the change of stance from withdrawal of accommodation to neutral. It's a softening of stance, and it's paving the way for rate cuts which could follow in the next policy onwards. Very benign statements on inflation as well, and especially interesting is when the governor talks about inflation as a horse that has been brought to the stable, but they have to make sure it doesn't bolt anymore. Moderation in inflation could reverse in September, so that is perhaps explaining why no rate cuts right now. Core inflation seems to have bottomed out, and important also that they expect government expenditure to now pick up pace. That has been slow so far relatively. Private expenditure and consumption has been pushing the economy. The economic outlook continues to remain positive. Jayesh Mehta, DSP Finance, with us this morning. Katrina L, Moody Analytics, joining us, as is Jaideep Iyer of RBL Bank. Welcome to all of you, and great to have you on the show. Jayesh, let me start with you with your take. Do you think that this was exactly what was expected, and we're now setting the stage for rate cuts to follow?
So this is, as far as stance is concerned, they already started infusing liquidity, and with the surplus liquidity, they had to change the stance. In terms of rate cut, they would like to see the actual figures. So that's where, right now, because of the base effect, the projection of inflation has not been changed at all. Even the GDP growth projection has not been changed at all. So by December, I think both of that could be lower, and that's where we have the scope for change in rate. Because as of right now, though inflation is under control and real rates are higher, but GDP is not the GDP is not suffering, the growth is not suffering, and that's why you could keep higher real rates of 2%, but that has to change, and maybe hopefully they will do that in December.
Right, we also have with us Katrina of Moody's Analytics and Jaideep Iyer. Jaideep, hi, it's Samina. I'll start with you. Most people believed that there wouldn't be much in terms of a rate cut or a change in stance. Interestingly, I do understand that the liquidity in the banking sector last week indicated that there could be a change of stance. From where we stand right now, what have you made of the policy, and what do you think is keeping the RBI away from moving on rates at this stage? Because if inflation is controlled more or less, then why wait?
No, so I think as a banker, first of all, I'm actually quite happy that we saw a change in stance prior to the actual rate cuts, because this is, by the way, the first, let's say, change in rate cycle that is expected when the banking sector has a significant amount of loans which are linked to external benchmarks and mostly repo. So from a purely banking standpoint, we would prefer liquidity to be easy for a while, where bulk rates come down, retail deposit rates start inching down before we have a rate cut cycle. So to that extent, I think it is good. I think the answer to your question on why rates, by the governor being cautious on rates, I think Jayesh mentioned that I think we still seem to have a very, very robust growth environment. In terms of GDP growth actually has been, I think, up in terms of estimates for the next 12 months. And we have a nice confluence of fairly stable macroeconomic policy, macroeconomic factors, current account deficit largely in control, fiscal deficit again path to consolidation. So I think in a way India is standing out in that sense, and I think given the let's say the geopolitical situation, I guess it is okay to be a little cautious on the cutting of rates front.
Okay, Katrina, good morning to you and thanks for joining in. What would you have expected from India's central bank, considering that, save for exceptions like Brazil, Japan, etc., most central banks are aggressively cutting? Would you have expected the Reserve Bank to do an encore, or is this a good heady mix? Move around with liquidity, set the stage for a cut, but cut only when India needs to, because India has got that luxury to be able to cut when it wants to, not necessarily follow the Fed.
Yeah, I think that's exactly right. So I think what we saw from the RBI today was really broadly as expected. I think it was a really good move in the extremely volatile geopolitical backdrop that we've got at the moment to provide as much forward guidance as they possibly can, right? And so the fact that they shifted to neutral, as they were widely expected to do, really does then set up expectations appropriately for a cut to come most likely in December. And I think one thing that I was a little bit surprised about was, I guess, the RBI's quite optimistic view on inflation. They've said that, core inflation has bottomed. Headline inflation is hovering just below that 4% midpoint target, which is a positive thing. But I think we also need to keep in mind there are those upside risks to food inflation, given weather impacts, but also, and perhaps even more importantly, given what we've seen in the past week or so in terms of that escalation of violence in the Middle East and what that's done to oil prices, we need to really remember that India's inflation, near-term environment is highly vulnerable to changes in global oil prices. And so I think keeping that stance in terms of rates being on a hold does kind of give them a bit more breathing space to keep inflation expectations more anchored, given the upside risk to oil prices at this stage.
To be fair, Governor did lay out exactly 3 risks, which was weather patterns, geopolitical, developments, and commodity prices that have gone on. But Katrina, I want to come to you on a slightly broader issue. So, with inflation relatively in check, perhaps Indian central bank doesn't need to cut prices right now. But if you look at it in context of what China has been doing, and of course the rate cut which we saw in the United States, do you think that December now is a given?
I don't think we can really say with any sort of certainty that December is a given. I think there's still quite a lot of life to be lived between now and December. And as the past couple of years have really crystallized for us, best laid plans can fall by the wayside in an instant. But I think what we are seeing is that the RBI has really set the stage, I think, for that December cut. But I think, things can change. And I think we need to be cognizant of that. I mean, it was only with the Fed's 50 basis point cut that came as quite a surprise to markets, because it was that outsized cut. So I think the good news is that the RBI does have that space to, keep rates on hold at this more restrictive territory if they need to, given that the domestic macroeconomic conditions are actually doing quite well.
Yeah, you want to come in on this one? It's not just crude. We've also seen a massive surge on coal prices. So both those factors usually disturb the macros of a country like ours. Of course, the governors talked about how core inflation has been reined in. Do you feel like there's a pretty evident, obvious upside risk to our inflation number, given the way crude has been moving recently? Jayesh, that's for you.
So I think, the way I look at this is we as market player, we look at both positive and negative on a expectation basis. Generally, central bank tends to actually see the data As of right now, they haven't changed their forecast either for growth or inflation, which market would have, on both the count, market is currently looking at a slightly lower than the projection. And maybe hopefully in December they will change it. So they would, when it comes to rate cut, they would be more going by actual data, whereas it is a precautionary rate hike or something, they may look at the forward-looking data. So that's the first premises, and that's where the disconnect between us and the market expectation and the central bank. In terms of risk, yes, these three risks are always there. Geopolitical, of course, is there, but for us, geopolitical actually comes to the crude price, right? And as of right now, we have seen enough tensions, but in spite of all that, it's still hovering in the 80s, right? And we haven't changed the retail fuel price and other stuff, so we have enough buffer. Unless it goes to maybe 120, 110, 105, that's a different story altogether. So even if you have a projection as of today, when crude price goes to 120, it's a very, very different scenario. So it's not predictable in that situation. And that can happen any day. It can happen the next day after a cut also. So that can happen any day, anytime in the world. So as of right now, I would say it's more of wait and watch, maybe see the, September, October, November data, and then maybe they will change the forecast either for inflation or for GDP growth. And that's how they will justify the cut. And I'm quite confident that will happen in December.
Fair point. By the way, just marking that banks are again recouping some of the lost ground, but NBFCs have stayed stable. And the financials, despite the cautionary warning for some of the NBFCs which are wanting to grow fast from the Reserve Bank governor, I think Nifty Finance by and large seems to be doing okay for itself. To be fair, Jaideep, I mentioned this last time that he would rather have liquidity conditions ease first and then a cut later. So that's what happened. He should be happy, as he mentioned. Getting another banker's view as well before I go back to Jaideep. Venkatraman Venkateswaran, who is the CFO of Federal Bank, also joining in. Mr. Venkatraman, are you happy with the moves done? No rate cuts, but stance change, setting the stage for a cut if need be, and liquidity measures, a lot of talk around that.
Yeah, hi, good morning. I think the announcement was in line with what was expected by us, with the no change in no rate cut, but change in policy stance. So that kind of gels well with what was expected. So there's no surprise per se on that. And in my view, what is important to watch, which the governor emphasized more than once, unambiguous focus. The word unambiguous was used at least 3-4 times in his speech. So the focus on inflation is pretty much there. And the food inflation obviously is something which they are watching very carefully, while the CPI is expected to settle at around 4.5% is what was mentioned. But what is important is how the food inflation plays out, and that will determine the next course of action. And of course, there are a lot of other factors which do impact the food inflation.
Mr. Venkatraman, just, in terms of the messaging which is coming out with no changes to the GDP outlook or the inflation outlook, do you expect that to be moved in the next policy? Because now you've had the change in stance, but do you need those bricks to also fall in place? What do you think now will give comfort? Because if inflation is largely on target, your repo is still at 6.5, that's an equation that needs to change sooner than later?
I think between now and December, of course, we can't predict much on the geopolitical and the conflict in West Asia. If you've seen off late, the West Asia conflict has taken more priority over what is happening in Russia, Ukraine. And a few days back, of course, the ministry had mentioned that the sources for crude oil import for us is beyond West Asia. But having said that, the impact of what happens in that part of the world will determine the overall crude oil price. In the previous meetings, I think it was mentioned that anything between up to $80 per barrel is something which is baked in. not a surprise on an average, obviously. But if it starts going up consistently beyond that, let's say in the next 2 months, then there is likely to be, see, it's all driven by data. So I'm sure the RBI will look at what are the recent data which they get, the festive season, how is the manufacturing growth picking up, the private capex, which have all started. How will determine the next course of action? But having said that, the change in stance is something which gives us comfort that it has been thought through. They are not going to kind of go back on that. So what needs to be seen is how does the Kharif, the sowing has been quite encouraging. We don't expect too much of weather vagaries in the next few months. So the monsoon is behind us, good monsoons.
Jaideep, come to you. You mentioned this at the last time, as I said, that this is what you wanted. It's come out this way. He's mentioned also that the conditions had turned into deficit, proactively conducted two-way ops, will continue to do this. What would you now watch out for? Because the commentary seemed dovish, the stance change has happened. What is next in store? Let's say you predicted this policy right. Now I'm asking you to predict the next policy, Jaideep.
Yeah, so Niraj, I think what banks would look for is sustainable, durable liquidity. So we don't want deficits going back again, and random reduction in liquidity. So we will expect the RBI to kind of maintain positive liquidity for elongated periods, so that there is confidence that this is going to be the norm rather than exception. And once that happens, we will start seeing some reduction in liability cost for banks. And therefore, banks will then be reasonably prepared for looking at when the rate cut happens, then obviously the asset side also starts getting cut. From an expectation standpoint, Niraj, I think my guess is that we are largely likely to be set for a cut in December, except for the lot of discussions around crude oil prices and the West Asia conflict. I think that is a joker in the pack, which is hard to kind of predict. But other than that, I think if you look at domestic factors, I think I would bet on the fact that there will be a cut in December.
Katrina, you want to come in on the currency? The rupee has been a well-managed currency from the time we can remember. Of course, we've seen a little bit of a decline, largely on back of the Japanese yen and the Chinese yuan activity against the dollar. With rates being left unchanged, what is your word on the dollar-rupee pair? And more importantly, there was some parts of the market that talked about how the rupee could become a carry trade currency if the rate differential remains elevated. Do you see that coming?
So, I think one of the contributing factors that we haven't really covered yet in this discussion about why the RBI has kind of held rates that little bit longer is to provide the rupee that little bit more support. We have seen, a bit more dollar weakness of late following this well-anticipated cut from the Fed. And so that's kind of been some support to the rupee. But at the same time, the rupee is still relatively weak by historical standards. And I think we need to remember that because it's relatively weak, it's also adding a little bit to imported inflation as well. So it's one thing that, food prices are tracking the way they are, and there is some upside risk to that. But at the same time, that ongoing weakness in the rupee should be considered. And I think if the RBI did actually come out and cut today, we would see renewed weakness in that currency because it wasn't such an anticipated move. So I think they've done some deliberate kind of, currency management with their communication today, which is important. And I think that's something that will kind of remain a factor right through the end of this year, particularly given this, more volatile geopolitical backdrop that we're dealing with. We have seen the strong dollar come off a little bit, but if we do see more heightened risk aversion in global financial markets, then we will see that dollar strength come on again. And so that's something to kind of just keep in mind through this global easing cycle that we're in the midst of, and that the RBI is kind of managing through with this still relatively weak rupee, but certainly I agree with you that it has been well managed through this earlier hiking cycle.
It is the invisible hand that we frequently talk about. Jayesh, you want to come in on your view on the dollar-rupee pair? Of course, we've seen a lot happen on global currency pairs. The dollar has strengthened. You've had the Japanese yuan, the Japanese yen, the Chinese yuan go through very big swings. Now, I know the rupee is a well-managed currency and always has been. Our reserves stand at record highs. I mean, apart from China and Switzerland, we're the only countries sitting on such big coffers. What is your view on the dollar-rupee pair? And do you feel like we do run a risk of the rupee becoming a carry trade currency until the rate differential between the dollar and rupee remains elevated?
I think, from a carry trade perspective, yeah, people do put a little bit of it, but not really much, because we are not still fully convertible. It's only through FPI route on the situation. And also, with the range being so narrow, right, it is very difficult to see the breakout. So when the breakout happens, especially with the geopoliticals and all that, right? The breakout can happen at 84, but it will not last long. Of course, fundamentally, we all look at it much going. So people do put in some carry trade, but it's like, the same thing happened at 83, same thing happened at 83.50. We are at 84. Though my personal view, I'm very bullish on rupee.